chase this market. Let it come to you.
The question isn't, will the market be healthy, but will it remain bifurcated?
There are legitimate questions about valuations.
I do think that the market is too negative on the economic outlook.
If you get any more downdraft in technology, it's going to be hard to rally through the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the sell-off deepens. Equity futures pointing to the longest losing streak since August. As a shakeout in Japan sends the Nikkei to its worst day since April, a breakdown in sentiment leading to Bitcoin briefly breaking below 90K. The risk aversion continues to simmer.
And it's changed its tone. It's not just locked up in the high flyers and non-profitable tech stocks, some of the more speculative bets. This has broadened out to travel stocks. Yesterday, Hertz, Avis, Expedia, all down 10% or more in the past three trading sessions. CarMax down almost 7%. You're seeing across the board this weakness that's pervading the American economy beyond just a big tech story. And it raises a question about what's going on. Does it have to do with the Fed? Does it have to do with big tech? Or does it have to do with momentum?
The consumer at Home Depot not coming to the rescue. Their stock is down in a pre-market buy. 2%. It's a downside surprise on earnings from Home Depot on sales. And this line stands out, Bramo. An expected increase in demand in the third quarter did not materialize.
Yeah, talking about how the full year earnings per share growth is probably going to be down about 6%. They saw previously down only about 3%. This highlights the conundrum for the White House and, frankly, more broadly for economists. Can this economy recover without the housing sector? Can this economy recover without all of the spending that comes with either having a new home or renovating? And Home Depot is the poster child of exactly how much that pain is transpiring. Is this a consumer issue? Is this a housing issue? Are these one and the same?
The stock is down by 2%. A downside surprise. Home Depot coming out this morning. Target tomorrow. Walmart after that. Let's talk about spending, some serious spending, and a lot of debt coming to the debt market. We've had $18 billion from Oracle. Meta delivering $30 billion of debt. Alphabet about 25. In the last 24 hours, $15 billion of debt coming from Amazon.
The numbers are racking up, and you're seeing the concerns start to lift a little bit of the spreads, at least in investment-grade corporate debt world, as well as in high yield. There is a feeling that the spending initially was coming from the cash coffers of some of the big tech giants, and now it's changing. Now suddenly it's coming from the debt markets. It's raising concerns, not because the hyperscalers can't pay it back, but where else is the leverage building? And I would just like to note that yesterday, private equity stocks and private debt stocks absolutely hammered, led by Blue Owl, which saw their shares down 5.6%. Blue Owl has heavily invested in the Meta deals and all sorts of other infrastructure and data center deals, and has been having issues with this one fund where they're not going to necessarily have quick redemptions. Real questions here about whether we're just seeing the tip of the iceberg or whether this is the blow off top that allows a healthier kind of move forward.
We're going to spend some time on this throughout this morning, but this just dropped, the Global Fund Manager Survey from Bank of America. Check out this title: Cash poor, capex rich, rate cut needy. Are we going to get those rate cuts? Based on the commentary we've heard so far, maybe not.
This is the real issue to me, and this is part of what's driving the risk-off sentiment right now. You've gotten pushback, although yesterday we did get a little bit more dovish speak from Vice Chair Jefferson as well as Chris Waller. There is a feeling that there is a lot of pushback on the Federal Reserve in a sense that we could get non-farm payrolls on Thursday for some reason, that will edify the sense that there is strength in the economy and might push some of the Fed officials not to cut. Does that send markets into a tailspin that have been expecting those lower rates?
You're not excited for payrolls Thursday?
You know,
no, doesn't do it for you.
I gotta say, I am excited. I think it's fabulous. Very excited to get some data. It's backward looking, and we've already heard people muddy the waters by saying if it's a high number, it's because it's payback from previous months. And if it's a low number, it really is just an adjustment because of the birth-death model and the fact that we've gotten lower immigration. So I don't even know what I'm looking at.
If you don't like September, I can't wait to show you the noise in October.
What October?
October is going to be a very messy jobs report. Payrolls, the estimate in our survey, 55K. That's the median. The estimates keep pouring in ahead of Thursday. Coming up this hour, Peter Tchir of Academy Securities with stocks adding to a three-day slide. Republican Congressman French Hill on the future of deposit insurance. And Sharon Miller of Bank of America on the key findings from the annual Business Owner Report. We begin this hour with stocks sliding as investor angst rises over valuations and interest rates. Peter Tchir of Academy writing, expect the equity rotation to continue. The NASDAQ 100 weaker from here. Not doom and gloom, just a healthy dose of profit-taking and repositioning of risk. Rotation, yes. Pain ahead, likely. Smooth sailing, unlikely. Pete joins us now for more. Pete, good morning. Good to see you.
Hey, good to see you too.
What do you make of those issues that we've seen coming from the likes of Alphabet, Meta, Amazon, Oracle? Why are they coming to the debt market when some of those companies have got so much cash?
You know, I think they're going to use some of that cash themselves. They are doing some of the financing through what's almost like a project finance type structure, and some of it's going to come out of their own balance sheet. So I think there's this realization that the data center and AI build out is going to be extremely expensive, and some of it's going to come from private credit, some of it's going to come from public credit, some of it's going to come from bank lending. And it's not just the data centers and AI, it's going to be the energy build out that's required for that as well. So I think that's starting to weigh on the market a little bit. Not much, but there's some pressure there.
What is this ecosystem built on? The balance sheets of the Amazons and Metas and Alphabets of this world, or the shaky, flaky promises of OpenAIs and others?
You know, I think it's still built on, everyone says we need to be in AI. The CEOs say we need to be in AI. We're spending AI. And you're starting to hear some positive stories where people saying, here's what we've got, here's the benefits, but you're also hearing a little bit rumbling underneath, like, we're spending this, what are we getting? So I think that's going to be the shakeout. Do we really see this benefit? And to be honest, at this stage, right, if it's really working for everyone, I think that should flow to higher multiples for the rest of the market. So even if AI turns out to be, as good as people hope, as quick as people want it to be, I think it should benefit the broad market, not just the AI producers and hyperscalers right now.
How much is this people trying to take chips off the table before tomorrow's NVIDIA report? Because NVIDIA shares have lost $500 billion since October 29th. On what? What exactly has driven that?
What drove it up either. I think we've got a lot of market structures issues. You've got zero data expiration options, and then you've got, the ETFs. And I do think it's been a change in the past year and a half that you have Bitcoin ETFs, right? People used to be able to hold their cryptocurrency holdings separate. It was in their own wallets, or maybe it was at Coinbase or something. They saw it there. Now it's in your portfolio, potentially at your Schwab or Fidelity, and it moves with everything else. And I think a lot of the people who are very heavily invested in disruption, they own that. They own ARKK, which is down, 20 some odd percent. They own the hyperscalers. So they own the same set of trades, thinking they were different. And every time we kind of get these hiccups, correlation seems to go to 1. So I think that's putting the pressure.
Is this partly spurred to John's point earlier about speculation that maybe the Fed won't cut rates in December, and that's taking some of the froth out of the system, leading this to sort of a very healthy kind of correction phase that could have more legs but actually will lead to a better ecosystem?
Right. I think people got a little bit carried away with the Fed and how much beneficial the Fed would be for this. So as that kind of backs off, we're down to warp. We're not even pricing in one full cut by the end of January right now. So that's kind of interesting to me. So yeah, I think it's a healthy thought about where do these things go. And it was a lot of money chasing. And again, momentum has been such a strong strategy. So people pile into momentum. The problem is when momentum turns, it turns very quickly because no one understood the valuations necessarily. So you don't have any sort of depth of value buying. So you're going to get this volatility. I think it continues for a little while. And again, I think a lot of people, including myself, you're looking at Bitcoin. There's been nothing but positive news out of this administration, out of the regulatory environment. Everything seems positive for crypto. Companies and countries are talking about owning it, and yet it's down. I think that's kind of a bit eye-opening.
What's the relationship between developments in crypto and what's happening in the equity market? How does one inform the other?
I think people are looking at anything that was kind of momentum. And again, I think there was a class of investors, particularly the day trader types, who really bought into momentum across all things. So whether it was the, hyperscalers, whether it was Bitcoin, whether it's, these leveraged plays, it's all one pile of money. And as that kind of gets hurt, they have to take some chips off the table.
Do you think equities are leading crypto, or is crypto leading equities?
I think crypto started this turn down. I think now maybe it's a little bit more balanced, but there were a few days you're like, why is crypto keep going down? Why is crypto going down? And then all of a sudden it kind of rolled over. And I go back to, I believe it was last Monday, right? We had this ripping day in stocks, up 700 on the NASDAQ. Crypto didn't do quite as well. And all of a sudden everything reversed starting on Tuesday. And since then it's been pretty much one way down for crypto and stocks.
So far, we've been talking about this like it's a gambling parlor. The idea of everyone trying to chase this chip and then kind of get blown out of this position, et cetera. There has been this sort of divergence between the underlying economy and the market pretty significantly throughout this year. I'm wondering if this feels different based on the action that we've seen in some travel stocks, in the sense from this morning's Home Depot reports that there really is this softness that's taking hold. Do you think that the sell-off in stocks could exacerbate that?
It could exacerbate that, but I think it could also be, just as you're saying, finally paying attention to some of this, right? There has been this weakness in the lower, income, consumer, right? We've seen parts of that. You're seeing a little bit of pressure in the credit markets. And one thing, we'll come back to this in a second on the credit markets, but I do think the data that we have, and we've been short on data anyways, doesn't capture what goes on in small businesses very well. I think our data is designed to capture big and medium businesses very quickly and timely. It takes a while for small businesses. Everything we see and hear anecdotally, and in some of the numbers you can get, is small business has been hurt the most by the uncertainty, right? They didn't have the deep capital, the working capital to get ahead on tariffs. They're uncertain about this. They run, maybe not month to month, but they do not have the same sort of, wherewithal to suffer through months and months of uncertainty. So I think as the small business data starts to hit the economy, that's where we're going to realize, wow, this is where the jobs are. And that would probably fit very well with Home Depot type of thing, right? That's the small contractors, right? Those are the ones who are struggling right now, who would do your home fixes and things like that. So I think the economy is worse than we realize. I do think the Fed should cut because I think that's data is going to show up weaker and weaker.
So if the Fed does not cut in December, one thing that we've talked about is how no corporate executive is talking about the potential for a recession. We just got forecasts from Wall Street. All the strategists seem incredibly bullish on equities and talk about a reacceleration. Are you saying that that's wrong?
I think there is a chance of recession, right? First, it's never been off the table, but we've been arguing even before the government shutdown, they were overstating the birth-death model. They assigned way too many jobs to EIN or employment identification number applications. I think they missed the boat there where people apply for EINs because they buy an Airbnb and they're going to set up an LLC to run that, or they're going to, do Uber Eats or something. And, I keep looking at what's going on in the quits rate, really low. Law school applications continue to go higher. All those things to me are indicators that everyone sees the economy is not that strong. So I think we have that possibility. And everyone has to be very careful right now because there is a huge incentive to say things are good because there's a lot of pressure coming from the administration, everyone. So you don't want to be questioning it. But I think maybe now it's time to question it so we can direct right policy. Some of that worked really well. Trump just backed off on tariffs on things that we don't grow here. I think that's smart. I don't think we should have ever put them on, but it's a good move.
Do you think there's a slow realization in Washington, D.C., in the White House, that the acceleration, the pickup in the economy is not developing?
Yeah, I think they are going back to maybe fine-tune or retune what they did. I think they went very big, very bold, whether that was the right thing to do or not, but now I think they're trying to figure out where are the pockets that this isn't working. I expect, again, we'll probably see a bit more cooperation with places like Canada on things like potash, on things like the tar sands oils, where we need this, right? We tried to do a lot very quickly. That was the whole plan. We know that he wants the economy humming along by November, so I think you're going to see some of these things revisited where they make a true attempt to fix things.
Peter Tchir of Academy is going to be sticking with us. The latest numbers from Home Depot not speaking to a pickup in the economy or any kind of reacceleration. This quote from the CFO: "We had expected demand to begin accelerating gradually in the back half of the year as interest and mortgage rates eased. But, and it's a big but, what we are seeing is ongoing consumer uncertainty and continued pressure in housing disproportionately impacting home improvement demand."
And frankly, we've seen this in the mortgage application numbers. We've seen this in just the average home sales. Turnover has fallen to a really low level. Transaction levels have fallen to recessionary types of levels. And it's interesting to me because it raises questions for the inflation backdrop. And Citigroup's Andrew Hollenhorst yesterday said that new rents are rising significantly below where they had 2 to 3%. So it sort of speaks to this idea that maybe it's not so inflationary, but are we overestimating some of the strength that people are saying that can take us to some sort of soft landing?
The Home Depot results are in the Governor Waller camp, that's for sure.
Yes. Home
Depot this morning down by close to 2% in the pre-market. With an update on stories worldwide with your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. Just recapping those earnings. Home Depot has cut its full-year guidance, warning consumers aren't making big-ticket home purchases. The company reported comparable third-quarter sales that missed estimates, saying the lack of storms also hampered demand in roofing, generators, and other categories. Meanwhile, initial jobless claims coming in at 232,000 for the week ending October 18th. The U.S. Labor Department posting the latest data to its website overnight. Continuing claims came in at 1.957 million, up slightly from 1.947 million in the prior week. The delayed September payrolls report is due out on Thursday at 8:30 a.m. Eastern. And JPMorgan Vice Chair Daniel Pinto is warning a possible correction may be due because of high AI valuations. Pinto becomes the latest Wall Street executive to show concern over a possible bubble forming in artificial intelligence. The JPMorgan Vice Chair made the comments at the Bloomberg Business Summit in Johannesburg earlier today. Bloomberg Terminal subscribers can watch the event and more with the function Live Go. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara in about 30 minutes' time. Up next on the program, a Saudi arms deal.
Are you planning to sell F-35s to Saudi Arabia?
Yeah, they've been a great ally. They've got to like us very much. I will say that we will be doing that. We'll be selling F-35s.
That conversation up next with Annmarie down in Washington, D.C. Live from New York City this morning. Good morning. Three-day slide on the S&P 500 could become day 4. We're down across the board. We're negative by 1/3% on the S&P, down by 1/3% on the Nasdaq. The Nasdaq in focus tomorrow after the closing bell. We'll have numbers from Nvidia, numbers from Target tomorrow as well. Walmart on Thursday. This morning, moments ago, Home Depot, a miss, and they cut the outlook too. And the commentary does not inspire confidence into year-end.
They were expecting the reacceleration, as so many people are, and they did not see it. The idea that the full-year earnings per share growth they now see as being down 6% versus previously seeing it only down 3% highlights just how much people are not coming back, and it speaks to the pain that we keep seeing in the housing market. Yes, Neil Dutta, I have been reading your emails.
Is that what Neil said to you just moments ago?
Well, he just has been talking extensively about the fact that you cannot have a real recovery without the housing market. That is one of the key drivers of a lot of jobs and economic activity. Think about how expensive it is to buy a home, to furnish it, all of those kinds of things. Many of us have been there, and there is a feeling that without that, it's hard to see that robust, broad-based growth. And this really speaks to that.
You said Neil, and my Bloomberg terminal lit up. I've had to mute it. I'm not sure if it's Neil or not. I'm going to check in a moment. Under surveillance this morning, we'll head down to Washington and look for a Saudi arms deal.
Are you planning to sell F-35s to Saudi Arabia?
Yeah, they've been a great ally. They've got to like us very much. Look at the Iran situation, what we did in terms of obliterating, we obliterated their nuclear capability. Yeah, I will say that we will be doing that. We'll be selling F-35s.
It's the latest this morning. The Saudi Crown Prince Mohammed bin Salman set to meet President Trump at the White House later this morning, with the two leaders expected to continue deepening ties. Annmarie's down in the nation's capital for more. AMH, selling F-35s. How has that been taken down in Washington?
Well, Jonathan, when it comes to the F-35s, this has been a long-standing request of Saudi Arabia, really for years. I think some mixed results when it comes to how it's being taken by a lot of members in Congress, especially given the fact that Israel might be a little on edge by the fact that they want to maintain that edge in military capability in the region. But the administration says they're going forward with this in selling the most advanced jet available for export to the kingdom. It is a massive step and a big win for the kingdom. But we should remember, this is going to take several years when it comes to selling these jets. One, Congress can hold up export license on these jets. Two, there's mass amounts of security concerns and some restrictions that go along with selling F-35s, which only go to really the closest of U.S. military allies. That is what happened when the UAE several years ago wanted to buy F-35s. In the end, they got bogged down and said no thank you. And then third, of course, potentially some pressure on Israel. But really, I think this would come down to some difficulties in the details when it comes to the security arrangement. So it's a big first step, but it's going to be years in the making.
AMH down in Washington. More from Annmarie in just a moment. Peter Tchir of Academy Securities still with us around the table. Pete, the Saudis get F-35s. What does the US get in return?
I think we get the money, right? We get the trade deficit reduced with them. And then I think this sets the stage for us to be able to sell NVIDIA chips to them. I think that Saudi's goal is all along to become the data center capital of the world. They believe they're well positioned to do that, and they've wanted our best chips. So maybe this is part of the outreach program. Hey, we'll spend billions and billions and billions of dollars on your fighter jets, but we'd also really like to spend billions and billions of dollars on your chips.
What's their relationship with China?
I think they probably play both sides a little bit, right? China is very happy to sell their top quality chips. Our top quality chips are much better than China's top quality chips. And I think the president has a very transactional nature, right? I think under Biden, we called them a pariah state, and we kind of, lost some ground there with what we were doing with Saudis. So I think Saudis will play both to maximize what they want. And I think the president's quite happy to reduce our trade deficit with them. It's been one of his key focuses. And if we sell F-35, so be it. Maybe that gives us so we can build the 6th generation fighters, right? And maybe that's what his goal is. Well, that's fine. We'll sell you these so we can build our own better fighters and ultimately maybe sell those to Israel. So I think this is all a matter of trade deficits, and chips somewhere behind the scenes are a driving force.
It's interesting how much Saudi Arabia has become a power broker internationally when it comes to the political sphere. When it comes to the banking sphere, it also has become the new node of trade in many ways. From the West, from the East, it sort of is the intermediary. How much have you observed that as this really does become the new power broker, both in finance as well as in politics?
I would say less I've noticed in finance, though. Having said that, Dubai comes up in almost every conversation. You got to get to Dubai. The hedge funds are in Dubai. Everything's setting up in Dubai. So you are seeing that region really grow and expand well away from just being this energy production or, energy source of, oil and natural gas, right? They really are, as a region, trying to move beyond that. Data centers is a very natural extension, given their ability to generate power, how expensive it is to ship oil versus shipping zeros and ones. So I think they're taking a lot of the right steps. That region is growing in that respect.
How much is this fueled, and no pun intended, I apologize, by this idea that Saudi Arabia and, frankly, the whole Middle East has a key part to driving oil prices lower? And right now, when cost of living is that much more important in the United States, lower oil prices has allowed an offset to some of the higher electricity prices in terms of affecting cost of living. How much is that part of this whole equation to a bigger degree than we're really understanding?
My general assumption, my working assumption, completely made up, but I think it's a probably safe working assumption, is the Saudis and Trump agreed if oil gets to 70, Saudis will keep it below 70. I think they'll support it at 50, because below 50, it gets hard for American companies to make money and to continue our production. So I think oil is going to be, it's a pretty wide range, 50 to 70, and Saudi is going to be a big part of moving that. And that's part of their maybe quid pro quo with this administration. We will do the things that we can to help you with your inflation and your energy issues. And that's why I think 50 to 70 is about the right range on oil. And you do things like to help us become the data center, which, again, fits us, fits our agenda. Jensen Huang was over there when he went to visit Saudi. I don't know that he's going to be at the White House with these particular meetings, but he's been very influential. He has. He's been very good, I think, at working this administration.
Hey.
How does Venezuela fit in to all of this?
So, I think one of the things that we're trying to do, I think, as a nation or this administration is trying to reshape our rules of engagement. So we have picked on Venezuela because it is a source of drugs. I think we've picked on Venezuela because it's far enough away that no one really cares that much what we do in and around Venezuela. And so I think we are setting precedent on what sort of ships we're able to attack, where we're able to attack those ships. It looks like we're taking steps towards Maduro. I think a lot of this is going to be a practice session for coming to Mexico at some point in the next year and saying to Sheinbaum, listen, we just dealt with the Venezuelan drug problem. We are happy to help you with your cartel problem. We would really like to help you with your cartel problem. And if you don't want our help and aren't going to do anything about it, we might do it on our own, because we've now established these new rules of engagement. So I think this is a precursor to what's going to happen ultimately with the cartels.
So it's not an energy story. There isn't an energy dimension to any of this.
There is some element of an energy dimension, but again, the Venezuelan crude, it's going to take years to get back into production. It's very, very heavy crude. China and India are also very involved there. So I think there's an element of that, but I think this is reestablishing. Again, this administration, I think, really wants to focus on homeland security, and again, more broadly defined, which would include the trafficking of drugs into this. So I think they've picked a relatively easy and soft target.
Yeah.
There's a huge statement that we've got the carrier there. The carrier does not need to be, as with Spider Marks the other day, and he explained it, it's a little bit like cooking an egg with a blowtorch. It's not necessary, but it's sending a statement.
Pete, it's good to see you, sir.
Great to see you,
Thanks
too.
for being here. Thank you very much. Peter Tchir of Academy. On the energy story, crude is in the 50s, just about 59.94 on WTI. Brent crude so far this morning, 64.19.
Yeah, and it really has been in that range, and it's been a huge pain trade, and it's been a frustration for some oil companies that have announced a lot of job cuts because they cannot necessarily reduce their production. They don't want to lose shares, so they're making it more efficient for them to operate. It just does raise a question, right? Some of these competing goals. Yes, national security on one hand, but on the other hand, cost of living issues in the U.S. And if you could conveniently put those together, well, I pat your back, you pat mine, everybody wins.
Win-win. Governor Waller made the point in a speech yesterday afternoon, making the point that there's no reason to worry about inflation. Focus on the labour market, and I'm worried about a stall-speed labour market, cut rates.
Yeah, and honestly, it sounds like McDonald's Happy Meals and Extra Value Meals are contributing to that whole plan.
Futures this morning down by 0.3% on the S&P. A big affordability push in Washington. Up next, Congressman French Hill. Three-day slide on the S&P 500, down across the board again this morning. We're looking at day 4. If we get day 4, the longest daily losing streak going back to August. On the Nasdaq, we're down a third. On the S&P, we're down a quarter. Not much of an offset in the bond market. Yields look like this: 2s, 10s and 30s. Bond yields down by about 3 basis points. 357 at the front end of the curve on 10s, down 3 to 410.76. Check out Japan. The Nikkei 225 down by more than 3%. In Asian trading, the biggest one-day loss going back to April. Yields up at the long end. 40-year bond yields, highest on record. 30 years, not too far behind. We're up 7 basis points on a session over in Japan. Been a pretty brutal 24 hours for Japanese markets.
Yeah, and it comes after Sanae Takaichi, the new prime minister, came out and talked about the potential for deploying Japanese troops to the Taiwan Strait. And this invoked the ire of Beijing. A lot of blowback there and a real question about how that could affect some of its economy now in the sort of about phase, but it highlights the geopolitics in the markets really coinciding in the fact that ultimately where the Japanese market goes, so goes the rest of the world, particularly on the long end of the yield curve.
The Japanese finance minister is in a tough spot. Finance Minister Katayama's come out and said essentially she's worried about the currency, but also the economic package they might deliver perhaps is going to be bigger than people expected. So you've got to weigh one up against the other.
And this really ultimately delivers the issue for Sanae Takaichi and the concern when she came into power, this idea that she would be much more stimulative in some of her offers at the same time that you don't necessarily have a Bank of Japan that's as willing to hike rates as aggressively as some people have hoped. This is the doom loop, right? You want to cater to some of the sentiment in the population. This is what people want. And at the same time, given the debt load that a lot of national and a lot of nations have, there is a limited scope to do so without roiling the currency markets as well as the bond markets.
And just a sprinkle of a diplomatic splat between Japan and China
makes it very difficult.
Not exactly helping the mood music around Japanese assets over the last few days. Equity futures then negative by a third. Let's lift the lid on the US side of things and get you some movers, some morning movers with Yahira. Hey, Yahira.
Hi, John. Home Depot is kicking off retail earnings with a warning. Those shares are down 2.25%. The home improvement chain is cutting its full year guidance, saying that consumers just aren't spending enough on those big ticket home improvement projects. Instead, they're spending on smaller projects, so that hits sales and profit in the last quarter. And that is not boding well for its competitor, Lowe's. Those shares are also down nearly 1.6%, falling in sympathy. We will get Lowe's earnings later this morning. Meanwhile, moving on to big tech, we are seeing Amazon and Microsoft shares also in the red after they got a rare downgrade over by analysts at Rothschild and Co. Redburn. They're downgraded both to neutral, saying that the underlying economics around generative AI are far weaker than assumed. This, of course, comes amid broader concerns around an AI bubble. And the analyst notes that he now sees a higher risk that Microsoft and Amazon are overbuilding on the AI front. And moving on to another AI skeptic, Michael Burry, out with a new post on X, and it has to do with Molina Healthcare shares. Those are rising 3.8%. The famous investor says that he is long the stock while also being long Palantir puts, a combo he says goes together like peanut butter and bananas. John?
There we go. I'll trust him on the peanut butter and bananas. You like that mix?
I was just going to say, normally you'd think peanut butter and jelly.
Yeah.
Peanut butter and jam. But peanut butter and bananas.
I've seen people do that for breakfast.
Peanut butter and bananas?
I've seen that around the office, yeah.
It's the same thing. You just mash it up and then it's jam.
I know a couple of people in the control room that dabbles.
Are you shaming? Are you peanut butter and banana shaming them?
No. Yeah. I know our director, John, does something similar. Just peanut butter on top.
Okay, there you go.
No bananas. Okay.
Honestly, I'm game for it.
Let's get you some news. On our radar this morning, the Saudi Crown Prince Mohammed bin Salman set to meet President Trump at the White House later on today. In his first U.S. visit since 2018, the leader is expected to discuss deepening ties on defense, trade, energy, and technology. Elsewhere, economic data from the period during the 6-week government shutdown slowly pouring in. Initial claims from the week ending October 18th totaling 232K. The figure was posted overnight to an online government database. And finally, Home Depot shares falling after the company cut its full-year guidance. The CFO warning consumers are hitting the pause button on big-ticket purchases, saying expectations for an end-of-year demand boost have failed to materialize. That stock is down by 2.3%.
Yeah, and citing the continued pressure in housing disproportionately affecting their demand and their clientele. And it raises this issue. How much is this a Home Depot story and a housing story? And how much is this a broader story that will be reflected in Walmart later this week, as well as some of the other retailers that we are going to be hearing from? Lowe's shares are falling in sympathy. There's a feeling right now going forward that the housing market has been in a world of pain and it's been isolated. It's been an idiosyncratic story. Is that starting to change with some of the investments and the sentiment that come around it?
And is some of the stress starting to go and migrate beyond low-income groups in this country? That would be a big change. Low-income groups have been struggling for a long time coming out of the pandemic. There was a moment where things were hot in the labour market. It was only a moment. Is it going beyond just that group now?
Yeah, and how much is this not just necessarily a pessimism or an inability to pay, but as Restoration Hardware CEO talked about a couple of weeks ago,
dropping F-bombs
about the ability to pass along price increases and saying, if you think that you can pass along these price increases on furniture, you are whatever, blank, 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 because ultimately that is what you're seeing. You're seeing margin compression also across the board, which highlights the pushback to some of these pricing. You might say disinflation, oh my God, cut rates, but then it raises another bunch of questions, which is why have other data points been so strong, especially given the fact that we just haven't seen a material breakdown in sentiment of corporate executives or, frankly, consumers either in terms of their actual spending.
I'm going to say the I word, so forgive me. Sort of breaking my own rules. There is one idiosyncratic piece of the Home Depot story, and Yahara mentioned it. Storm season wasn't tremendous for them. It wasn't bad for everybody else, and ultimately it led to people not rebuilding their homes in quite the same way. That's the one idiosyncratic piece of the story coming from Home Depot for the third quarter.
Let's see the other earnings. We've heard similar things. I do think it is interesting, and I do wonder if this is really just about the fact that our homes weren't blown down, so we were not forced to rebuild. But there is a feeling that there is a broader sense, and that's why you saw travel stocks in particular take a real hit over the past couple of days. That's the reason why some of the rhetoric coming out of some of the retailers, I'm thinking of Deckers, if you don't have the premium product...
Deckers has been crap all year.
Okay, but part of this is if you don't have a competitive advantage in running, say, if you aren't Hoka or you're not On Holdings, then what can you do to pass along price increases that are pervading your items? And right now the answer is not much. And that is, I think, you're seeing more and more.
Home Depot down by about 2.5% so far this morning. Let's turn to Capitol Hill. Affordability, top of mind in Washington. The Treasury Secretary Scott Bessent telling media that President Trump's plans for $2,000 tariff dividend checks will require an act of Congress. Annmarie is down in Washington, D.C. and stands by with a special guest. Morning, Annmarie.
Good morning, John. That's right. A man that potentially could be running hearings about this or will definitely get a vote on it. The chairman of Financial Services Committee, Congressman French Hill of Arkansas. Good morning, Congressman. Thank you so much for joining me.
Great to be with you. Thanks for having me.
So as Jonathan was saying, the Treasury Secretary over the weekend was talking about how Congress would have to act for these $2,000 tariff dividend checks the president has floated. Do you think that's something Congress would get on board with?
I think Congress would certainly consider it. I mean, my judgment has been that I think the tariff revenue that's sustainable, that people believe is sustainable in the years ahead, ought to be used to reduce the deficit. I think that would be a much better macro use of it. We are concerned about affordability in Congress. In fact, in our committee, we're going to have a hearing on housing affordability. How does federal policy, how could that encourage housing construction, development, and also improve affordability when we know the biggest barrier to housing affordability has been, first, unprecedented inflation. Commenced by the Biden administration and the Fed's mistakes in and during and after the pandemic. But what can we do at the margin in federal policy to increase housing construction and affordability?
Well, I remember when the second round of checks went out to the Americans during COVID, the Republicans really made it part of their criticism of the Biden administration was that they were goosing inflation. Could $2,000 checks do the same next year under a Trump administration?
Look, I think inflation is caused by too many dollars chasing too few goods. And I think the origin of this inflation, a 40-year high of inflation that we had after the pandemic, was due to fiscal mistakes by the Biden administration, approving and spending another $6 trillion in federal spending that we borrowed. And secondly, by keeping rates too low and the balance sheet too big coming out of the pandemic. We're now healing from that. Inflation is down. Oil prices are down. I think the consumers are going to feel better off in their pocketbook from that. But we have to be wary that one of the biggest concerns that families have is the affordability of housing. And that's where I think we should tackle that at the federal level by removing barriers to more affordable housing and access to credit for housing.
Jonathan, Lisa, we're just talking about Home Depot earnings. They said that ongoing consumer sentiment has been a little bit weak. There's uncertainty there. Of course, Walmart's going to be reporting towards the end of the week. That's your constituent. Have you been hearing from Walmart and other either small businesses or big retailers about tariffs and how it has been difficult to pass on some of these costs?
Well, I haven't heard so much about, I've heard both about passing on costs for some small manufacturers. You know, American small manufacturers, our country is filled with that. And about 50% of manufacturing inputs for small business come from abroad, and 50% are sourced domestically. And there are some American manufacturers and small businesses that don't have another supply source. So they are hit in the short run by across-the-board tariffs, which is why generally I've not supported across-the-board tariffs. I think you ought to target countries for bad behavior, mercantilistic behavior, non-tariff barriers, negative tariffs towards the U.S. market, or target particular industries you think should come back in the supply chains, whether it's steel, aluminum, and then target that over a long period of time. So, yes, I've heard from my constituents about this, and this is why I think the biggest challenge is not so much the tariff rate as it is in the uncertainty about planning around tariffs. And I hope the administration can come to the decision that they've made tremendous trade successes with many of our partners around the world. Let's embrace those changes and get those implemented, and that will give certainty to people planning for 2026.
You're having your first hearing today since the government has been reopened, and it's about deposit insurance. So when I think of deposit insurance, I'm always reminded of the sign at the bank that says you are FDIC secured up to $250,000. What kind of changes could we see to that minimum?
Well, over the last couple of years, Congress has had some hearings on deposit insurance about a couple of things. One, should the $250,000 level be raised? But due to inflation, it was last increased as a result of the 2008 crisis. Secondly, should we reauthorize the TAG program, which is an emergency program to guarantee transaction deposits in the face of a systemic problem with the U.S. banking system? That has been expired over the years, and so I think Congress should reconsider that and look at it. And then should we have a deposit insurance study at large about how deposit insurance is working for the American people? This is important. It's a priority for the committee, and it's a priority for the Senate Banking Committee, so we look forward to the discussion today.
How long would something like that take to actually do?
And what specifically?
Raising the $250,000.
Well, I think it could be raised according with inflation, but I think this is where I think a study and being data dependent is important. So many people make emotional decisions about finance. I think we ought to study, make sure we have the numbers, make sure we know the unintended consequences of any aspect of change of the deposit insurance system. You don't want to increase moral hazard. You want to maintain bank competitiveness for banks of all sizes. And that's important. And that's why I think we should take it in a deliberate way.
We talked about the kitchen table issues facing American families, what's going on in the banking sector. The headlines today, though, in Congress are going to be about this Jeffrey Epstein discharge position. Mm-hmm. How are you expecting to vote, and how do you think other Republicans will vote today?
I think people want transparency, and that's why Mike Johnson's done a good job, contrary to a lot of the mainstream media. Mike Johnson asked Jamie Comer, our Oversight Committee chair, to study this intensely, investigate it with subpoena authority. And he's released everything that's a DOJ or FBI-related document and the Epstein estate that can be legally released, meaning that's not covered by a court order not to release grand jury investigative material. The Massey proposal on the House floor that I think most Republicans and Democrats will support at the end of the day calls for releasing everything, irrespective of those court orders. So I think you'll see litigation. If this were to be passed by the Senate and it became a law, I think you'd see litigation about protecting the confidentiality in grand jury investigations, which is why I believe that the Comer approach and Speaker Johnson's approach was more deliberative and appropriate. But all, I think, Republicans and Democrats want transparency around the Epstein matter.
Congressman, thank you so much for your time
this
morning.
Great to be with you.
Great to see you in Washington. Great to see Congress back at work. Jonathan, Congressman French Hill, of course, also chairman of Financial Services. When it comes to a $2,000 check, sounds like everything is on the table. But his main concern is using those tariff dollars to bring down the deficit.
Annmarie, appreciate the update down in Washington. Always good to hear from Congressman Hill. a very prominent Republican on Capitol Hill, diplomatically, carefully, just exposing some of the flaws in the tariff strategy of the last 7 months.
Saying he would have supported a narrower, more targeted package of tariffs, not the sort of broad-based approach. Is this pushback going to continue? We've seen it with coffee. We've seen it with bananas. We've seen the president become more aware of this. Does the Supreme Court case and potential any overturn give political cover to backtrack on some of this?
What's the date for finding out the result of that? Turn of the year?
Yeah,
end?
I mean, honestly, it's sort of a moving target. There isn't sort of a schedule of releases that's sort of announced, but the expectation is the turn of the year, probably the beginning of January.
What to look for going into year end? To look for this morning, look out for the market. Look out below. We're down by about 0.25%. Call it a third on the S&P 500 with an update on stories worldwide with your Bloomberg Brief. Here's Yahara Arnold. Hey, Yahara.
Hi, John. Rio Tinto is adding new surcharges on aluminum headed to the U.S. as tariffs tighten supplies and inventories drop. The U.S. relies heavily on foreign aluminum as it doesn't have the capacity to produce enough to meet demand. The fees stack on top of the already high Midwest premium, pushing costs to more than 70% above the raw metal price. Meanwhile, Larry Summers said he plans to step back from his public commitments after his correspondence with the late disgraced sex offender Jeffrey Epstein was made public by U.S. lawmakers. Summers, a Harvard professor and paid contributor to Bloomberg TV, said he will continue to fulfill his teaching obligations. And another high-profile departure at Apple, sources telling us here at Bloomberg that Abdur Chowdhury, an industrial designer who helped develop the iPhone Air, has left the company for an AI startup. Chowdhury spent more than 6 years at Apple, joining around the same time famous design chief Jony Ive left the company. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the program, listening to Main Street.
This dour view expressed by consumers, which may have been affected by the shutdown, lines up with what I'm hearing from U.S. businesses.
A conversation up next with Sharon Miller of Bank of America, live from New York City. You're watching Bloomberg TV. New fund manager survey from Bank of America. Number one most crowded trade, Long Mag 7, not a surprise. Number one tail risk, AI bubble. Again, not a surprise. But for the first time in 20 years, investors say companies are over-investing. After complaining they weren't investing enough for 10 years, now they're over-investing.
Yeah, and you can see this fear, although you could argue maybe these investors are also over-investing because their cash holdings fell to a low that is often seen as an incredible sell signal. 3.7% of their allocations currently in cash. So maybe the over-investing is percolating beyond just corporate America.
Equities pulling back. We're down a third on the S&P, down 0.4 on the NASDAQ 100 so far this morning. Under surveillance this morning, listening to Main Street.
This dour view expressed by consumers, which may have been affected by the shutdown, lines up with what I'm hearing from U.S. businesses. Slowing labor demand is also being echoed in surveys of employers and workers. Many businesses may be cutting jobs or allowing levels to fall by attrition in connection with actual or anticipated productivity gains from AI.
So here's the latest this morning. Wall Street bracing for a wave of economic data leading up to Thursday's payrolls report, with questions mounting on the health of the labor market. Bank of America publishing its annual business owner report with an optimistic view, finding over half of business owners expect to maintain staff levels over the next 12 months, with only 1%, yes, just 1% of business owners planning to lay off employees. Sharon joins us now for more. Sharon, an optimistic take. What else did you find? Talk to me about revenue expectations, plans to expand. Does it look good going into 26?
Well, it's great to be here with you all today. And yes, the view is really cautious optimism as we look ahead at the next 12 months. So 74% do expect their revenues to increase over the next 12 months. And over half believe the national, local, and global economy will improve. And 60% plan to hire. So as you think about what's happening in small and mid-sized businesses, I would say that it's very cautiously optimistic outlook would be how I would characterize this.
Sharon, one aspect of this is their ability to pass along prices, because a lot of them were affected and have been affected by inflation. You saw that in a significant way. 88% say they're currently being impacted by inflation, which is consistent with last year. How easy has it been for them to pass along those price increases?
Well, you're right. Inflation has been an issue. Nearly 88% said they have been impacted by inflation. And then the other item is supply chain and making sure that they have the right sourcing for their materials. So, they are passing along some of those price increases, and some are, taking it. It just depends on what type of industry you're in and how flexible the ability is to pass on those to consumers. So we hear both. But I will tell you that inflation is starting to cool and the supply chains are starting to stabilize as we move forward into 2026.
Sharon, there's a good degree of nervousness this morning in some of the consumer-facing stocks and some of the retailers. Home Depot came out, a real concern there about how much it's a housing-specific story and how much it's a broader consumer pullback. I'm just wondering, can you pull together what you're hearing from businesses with their hiring plans, with their sense of the economy? Does it jibe with the sense that things might be slowing a lot more than the overall data might suggest?
Well, in our data, and we do not only survey clients, but we use our data that we have available through the bank. We are the number one lender to small businesses in the U.S., and that's been for the last 17 consecutive quarters. So as you think about what's happening with our client base, we are seeing profits still rising. And as you look at what's happened over the past 5 years, most businesses, their revenues have increased, their profitability have increased, at least what we are seeing in our numbers and in the conversations we're having across the desk from clients. So, as you think about different industries, different sectors, you will see different outcomes. But at the end of the day, we are seeing still strength in the consumer spending, and that is fueling business on Main Street.
Sharon, have you seen any softening in the relationship between expectations for revenue and expectations for hiring? I think this is really important. I'm encouraged by the numbers I see in your survey, but is that number lower than it traditionally is? That 43% that expect to carry on hiring, would it typically be higher alongside that higher, more robust expectation for revenue?
I think we've seen, it ebbs and flows through the years, but I would say, 41% expecting to hire over the next 12 months. That is a strong number as you think about what you might hear in the NFIB surveys or with even planned layoffs. We are not seeing that within the small and mid-size space. We are seeing, as you noted in the beginning of this segment, only 1% do plan to lay off any workers. So we are seeing more efficiencies gained through AI. There's a lot of investment happening in AI, and that's being used more for marketing and driving new customers. So the spirit of the American business owner, both small and mid-size, as we go into 2026, there is a recognition that it will continue to grow. And really, because they are smaller, we do have the opportunity to be more nimble and pivot based on what's happening with the economy and their local markets.
Well, thank you for sharing some of that data with us this morning. We appreciate it. Sharon Miller there, the president and co-head of business banking at Bank of America. I'm encouraged by that because that would be my number one question into next year. Great, you're making loads of money. You're looking to expand. Fantastic. What are your hiring intentions for 26? Because things haven't been looking great in 25.
I thought your question was a great one because ultimately it goes to the question of, are we seeing people hire but less than they otherwise would based on their revenue increase? Is there any evidence that people are doing more with less? And when I say less, I don't mean less money because that investment's happening. I mean fewer people. And that, I think, is a good question to keep asking.
Up next on the program, we'll catch up with Sonders of Charles Schwab, the University of Virginia professor, Jennifer Lawless, ECB Supervisory Board Chair, Claudia Buch, and Herr of JPMorgan Asset Management. The second hour of Bloomberg Surveillance up next.
There's a lot of anxiety about the consumer right now.
You are seeing this bifurcation in the U.S. consumer.
We haven't seen the majority of price increases I think that we might see happen.
Inflation is likely to be more volatile.
The economy has been remarkably resilient for the last 8 months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. 3-day slide, it looks like day 4. We're down a third of 1% on the S&P. On the Nasdaq, we're down by 0.3. On the Russell, we're down by a third of 1% also. In focus, Home Depot in the pre-market, negative by 2.8%. Out with numbers an hour ago. A miss, a cut to the outlook, and a not-so-ringing endorsement of a pickup in economic activity into year-end.
They had expected that acceleration into year-end, particularly with big-ticket items. They did not see it, and it seemed like that was going to continue based on their expectation for full-year earnings per share growth coming in at a negative 6% versus the expectation of negative 3%. There is a question with the sell-off that we've seen over the past few days. Is this something different? It's not just a momentum-driven downdraft. It's not just a question, a blow-off top of some of the high-tech valuations. There's a question about the consumer and whether it's ready to fall out of bed, especially if the Fed doesn't deliver a rate cut next month.
The consumer is telling you things aren't great. The companies that pick up on consumer activity are telling you that things into year-end aren't great. Sharon Miller of Bank of America on the program just moments ago talking about a better 2026. So if you're a policymaker right now, you're stuck between the reality of a 25 that's soft, the promise of a better 26, what do you do? Risk management. Governor Chris Waller's making the point that you still cut interest rates at the December meeting. Do not take any of this for granted. Don't believe things are just going to pick up when things are still so soft.
You know, Fed Vice Chair Jefferson came out yesterday in a speech and said something similar, talking about how they have seen risks to the labor market grow. And they do point to a number of the data points that other people have, in particular, some of the quits rates, the idea that people don't feel free enough to quit their jobs. You are seeing lackluster hiring across the board, even with earnings, which is the reason why I think it's important to keep pointing out, yes, a lot of these companies are feeling pretty good, but are they hiring commensurate with the optimism that they feel for the economy? You made that point just earlier. And there's a question here about whether the parts of the economy that are most interest rate sensitive are in recession. And that's, I think, the question that Home Depot is really pointing to. How much housing represents a broader swath of the rate sensitive economy?
The weight of this market on the shoulders of Nvidia going into the close tomorrow when we get earnings after the closing bell. That earnings report is massive for this week, given how shaky sentiment seems to be around this story now.
There is a feeling that what was once a cash-based investment is increasingly a leveraged one. Nvidia shares have lost $500 billion since October 29th. That's just a couple of weeks that they've seen a massive decline, 10% drawdown. And it raises this issue of what is the ultimate goal? Are these companies at some point going to stop spending so much and start reaping the profitability of all of this data center build out? Or are people trying to build to the moon and compete with one another, and it's the arms race to where that ends up creating a lot of leverage and a very different structure for big tech? These are some of the existential worries baked into markets right now. How much further they have to go is really the question that a lot of people keep asking.
Equities this morning pulling back by just 0.4% on the S&P, adding to recent losses. Coming up this hour, we'll catch up with Sonders of Charles Schwab as the tech sell-off extends. Jennifer Lawless of the University of Virginia as President Trump brings his affordability pitch to McDonald's, and Herr of JPMorgan as Amazon raises billions in its first U.S. bond sale in about 3 years. We begin this out with stocks edging lower. Sonders of Charles Schwab writing the following. The AI trade has been struggling recently, but there is some interesting churn under the surface. Lisanne joins us now for more. Lisanne, welcome back. 4-day move, potentially a 4-day slide on the S&P 500. Talk to us about that churn beneath the surface. Is there something concerning, maybe something encouraging into year end?
Maybe a little bit of both, John. And this churn story is not a new story. If you go back to the April 8th closing low and just look at index level performance, in the case of the S&P at the index level, the maximum drawdown is only about 5%. And that was actually back in April when we had a little bit of that retest after the pretty ugly first week in April. Since then, the market's obviously been up significantly. However, the average member within the S&P 500, just since the April 8th closing low, has had a 17% average drawdown. And in the NASDAQ, over that same period of time, the average member has had a 39% drawdown. So there's already been a lot of churn under the surface. It's just been masked when you've had these mega cap driven components of the rally. You don't see the churn under the surface. That could continue. That said, that also provides opportunity, and maybe one of the reasons why, as you see a bit of a pullback in some of the prior high flyers, there's money finding its way into areas that had been less loved. You know, healthcare and energy is two examples of that.
Listen, where does the consumer fit in? We were just talking about the Home Depot numbers, not great. Target tomorrow, Walmart Thursday. Where does the consumer fit into that broader trade?
I think the consumer is under a bit of pressure. Wage growth in nominal terms has been coming down, certainly at the low end. A couple of years ago, the interesting story was that on the lower income end of the spectrum, the lower wage end of the spectrum, the wage increases were actually greater relative to the upper end. That phenomenon has reversed. And the fact that you've got within inflation, there's so much focus on goods inflation versus services inflation or tariffed impacted goods versus non-tariffed impacted goods. But the discretionary, non-discretionary divide within inflation, I think, is the real tell in terms of why you're seeing this pressure on the consumer, because you've got the discretionary components now down with a one handle on it in terms of those categories within CPI. Those would be the wants categories. Yet it's the non-discretionary categories, the needs categories, where you still have sort of a 4-ish% inflation rate. So given that the low-end consumer spends disproportionately on those non-discretionary goods, that's why I think the pain pressure is so much higher and why you're seeing it manifested in so many companies that don't just cater to that lower end, but that's where they're seeing the weakness.
Yeah, CarMax yesterday down just almost 7% just in one day. And you're seeing a lot of the travel stocks, in particular Hertz, Avis, and Expedia, also taking a real hit. And it goes to this question, Liz Ann, at what point are there pockets of the economy, pockets of credit that are exposed to this particular consumer weakness that are just getting sussed out now?
Yeah, so the whole cockroach theory, everybody loves to cite Jamie Dimon for that. And I think there's validity to that. I think maybe a differential relative to periods in the past, and I'll use another bug analogy, cockroaches and termites are different things. And it's not surprising that you're starting to see more fissures here, but I'm not sure it's something that suggests the overall foundation of the financial system is threatened here. I'm not going to say the I word. I'm like John, I don't like that word. I think it gets overused. I also don't like the word uncertainty. I think unstable is probably the better descriptor here. But I think it continues to mean we get a lot of churn, and that some of that money that had been pure momentum chasing without regard for what was going on from a macro perspective or into areas like fissures in the credit markets, I think there's maybe a little bit more discernment happening here right now, and an attempt to bring some sort of quality and value back into portfolios.
How much more of a decline or drawdown, particularly in the high-flying stocks this year, Liz Ann, would you have to see before you got more constructive and you felt like it was truly a buying opportunity rather than something that might be endemic of some other issues?
Probably a bit more to go. You've got the valuation excess concern, although I'm always one to point out that valuation is a terrible market timing tool. It doesn't, if you have, say, a 1-year time horizon, valuations at any point are not a good descriptor of what's going to happen in the next year. I think the rub right now is that if you look at, let's pick on the Mag 7 cohort as a proxy for the high flyers. Earnings growth rates have been descending for that cohort from more than 50% a year and a half ago or so down into the high teens. At the same time, the other 493 are actually seeing accelerating pace of growth. Now, in level terms, the growth rate for the Mag 7 is still higher than the growth rate for the other 493. But as I'm fond of saying, and for a long time, is better or worse often matters more than good or bad. So there is an expectation that we'll start to see a leveling out in that deceleration in Mag 7 earnings growth rates before you maybe start to slightly accelerate. But I think it's that differential and the direction of travel, up for the other 493, down for the Mag 7. So it's not just a valuation issue. It's a concern about the direction of travel for the underlying denominator of the equation.
Liz Ann, you've seen it all. We're down 3% from all-time highs. Liz Ann, I just wonder how spoiled we've been. A 3% move on the S&P 500, and some of the commentary around this market just sounds dreadful. Is this the most painful 3% move you've ever seen?
You know what's really amazing about this backdrop is how quickly attitudinal measures of sentiment swing. I've been a sentiment follower for my nearly 40 years doing this, and there in the past has been a little bit more commonality between the behavioral measures of sentiment and the attitudinal measures of sentiment. Now we see something completely different, where you see the behavioral measures of sentiment, fund flows, put call ratio. You don't see that swiftly moving to sort of react to a little bit of concern. To your point, only a 3% drop in the market. Some of those attitudinal measures of sentiment swing wildly toward pessimism. It just doesn't tend to get corroborated by the behavioral measures of sentiment. I think that unique backdrop is likely to persist.
Well framed. Lizanne, thank you. As always, good to see you. Lizanne Sonders
Good to see you guys.
of Charles Schwab. It's like 3's the new 10. Sentiment just gets absolutely whipsawed on a 3% move at the index level.
Maybe we're all just hyper-focused on the idea that social media is trying to make our emotions rise and fall at a much higher intervals and troughs. Maybe that's the issue.
It's a more emotional market.
Emotional society.
Futures down by 0.5% on the S&P 500. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahira Anand with more. Hey, Yahira.
Hi, John. Federal Reserve Governor Christopher Waller standing by his view that the central bank should lower interest rates when policymakers meet next month. Waller citing a weak labor market and saying monetary policy that is hurting low and middle income consumers. Waller says another rate cut would represent good risk management. Meanwhile, Roblox is rolling out a new age verification tool. Starting today, the gaming platform will ask users to verify their ages with photos or videos to increase safety. Roblox saying the update should ultimately boost long-term value for shareholders as it faces lawsuits over its child safety practices. Tune in to B-Tech at 11 a.m. Eastern for an interview with the Roblox CEO. And the U.S. is expediting visas for foreign visitors with tickets to the World Cup. President Donald Trump said government agencies are working to ensure that soccer fans from around the world are properly vetted and able to come to the U.S. next summer easily. World Cup matches will take place next year in 11 U.S. cities from July 11th to July 19th. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. Up next, President Trump's affordability pitch.
The word is affordable, and affordable should be our word, not theirs. Now we have normal inflation. We're going to get it a little bit lower, frankly. We want perfection. You know, you always want 1%.
That conversation up next with Jennifer Lawless of the University of Virginia. Live from New York City this morning. Good morning. %3 move on the S&P 500. Feels like the world is ending. 3-day slide on the S&P could become day 4. We're down by 0.5% on the S&P 500.
Hold on a second. Okay, yes, it's 3% on the headline, but Lizanne Sonders framed it really well.
Yes, I know.
You've actually seen a broadening out. NVIDIA has lost $500 billion.
I've got it.
In just a couple trading sessions. This is not a little bit.
Saying
I feel the pain. I'm feeling the emotion. We're an emotional society, John.
It's been a relentless move up and to the right for 7 months.
I know, it's hard to deal with the losses.
3% move at the index level, and it feels brutal. It feels bad. It feels painful because we've seen moves like that in widely held names like NVIDIA.
And there is this existential concern that this is the beginning, the tip of a spear, and that there is a lot more to go, although we have seen emotions that fly a lot higher than sometimes the representative moves in the equity markets.
Consumer numbers haven't been great, haven't had much data, so we're leaning on the retail earnings. The Home Depots of this world. Home Depot, not fantastic. Later on this week, you'll hear from Target and you will hear from Walmart, and we'll get some jobs data too. So by the end of the week, we should have a decent snapshot. I'm not going to overemphasize the word decent, but fairly decent snapshot of where this consumer is going into year end.
Is this just about home renovations and people maybe prolonging some of the decisions to renovate their kitchens or bathrooms, or is this something that goes to a deeper fear of the future, of inflation, of job stability for a lot of different consumers? Do we get that sense from Walmart and Target, or is this going to be a tale of two halves where Target continues to struggle and Walmart continues to get market share? Because ultimately, I don't want to use the I word either, but there are a lot of corporate stories here that are also riding in tandem with the consumer cycle.
Affordability very much in focus in Washington. Under surveillance this morning, President Trump's affordability pitch.
We are doing better that we've ever done as a country. Prices are coming down. The word is affordable, and affordable should be our word, not theirs, because the Democrats got up and talked affordability, and they don't say that they had the worst inflation in history, the highest energy prices in history. Now we have normal inflation. We're going to get it a little bit lower, frankly. We have it down to a low level, but we're going to get it a little bit lower. We want perfection. You know, you always want 1%.
So here's the latest this morning. President Donald Trump touting his administration's economic policies as he takes steps to ease price pressures. The president also praising McDonald's for lowering costs. Annmarie joins us now from Washington with a special guest. Hey, Annmarie.
Hey, John. Good morning. That's right. We're now joined by Jennifer Lawless from the University of Virginia to discuss this. Jennifer, thank you so much for joining us. I just want to start with who is winning the airwaves when it comes to tackling the affordability crisis in America?
If we look at the election results from a couple of weeks ago, the Democrats are definitely winning in terms of messaging, largely because affordability strikes at the heart of what Americans are grappling with right now. And their successes in Virginia, New Jersey, across the board, New York City, suggest that people don't like what's going on with the economy, regardless of the actual numbers, which is what Donald Trump actually benefited from in 2024.
How much of this is in response to the elections we just had in Virginia, where you're sitting, in New Jersey, Prop 50, of course, in California, as well as the New York City mayoral race?
Well, I think those elections tell us two things. The first is that the affordability pitch put out by candidates like Abigail Spanberger and Mikey Sherrill resonated. And it didn't resonate only among Democrats. The messaging also resonated among independents who split heavily for Democratic candidates. So that suggests that people are concerned about the economy. They're concerned about rising prices. They're concerned about the money in their pockets. And this was exacerbated by the government shutdown. The second thing that the elections tell us is that the Republicans, and Donald Trump in particular, listened, because it's only been after the elections that we've seen the Republicans and this White House pivot toward issues of affordability. Now, the messaging is different, and he's trying to convince people that the economy is better than it feels. But it's certainly he's trying to address people's concerns about kitchen table issues.
Isn't that what the Biden administration, though, did as well? The Biden administration, I remember former President Joe Biden said at one point to reporters, the economy's doing well, you should be writing about it. But it wasn't what Americans are feeling. So how do they walk that very fine line?
It's a very difficult needle to thread. The Biden administration was unable to do it. As the numbers were trending in the right direction, people didn't feel it. And Biden and the Democrats were held accountable in 2024. We see that same thing happening to the Republicans in 2025, because people are not going to vote based on what things used to be. They're going to vote based on what things are right now. So even if prices are coming down, if prices are higher than they want them to be, the party in power is going to pay the price for that. And we saw that on Election Day. Heading into the midterms, whichever party is better able not only to bring down prices and to make things more affordable for Americans, but also to convince them that they've done so, will win.
Well, we know on the convincing part, they are definitely trying to spend a lot more time talking about this with the president yesterday, talking about how inflation is normalizing. When it comes to actually policy proposals, do you see an appetite in Congress for this $2,000 tariff dividend check President Trump has proposed?
No, it's unclear that there's any appetite. It's incredibly expensive. And as the Secretary of the Treasury made clear, Congress actually does have to pass it. And so the promises that Donald Trump is making on this front could ultimately come back to be a problem for him, because it's not clear that he has Republican support behind him. Moreover, even though this is affordability week and he's trying to focus on prices, he's very easily distracted. And we see that many other issues have risen to the forefront. So we're on Tuesday. He still has a few more days this week to focus on affordability, but it's unclear that that's what the headlines are going to be, or that that's what Americans are going to be focused on as the news progresses over the course of the next 4 days.
Right. Sometimes it is hard for any administration to really try to control the headlines. When it comes to affordability, though, and his tariff plans, the president has brought down some tariff levels for key agricultural and food products like bananas and things like coffee and beef. Do you think this is the administration moving in the right direction on affordability, or is it them almost admitting that tariffs do cause price increases?
I think it's a little bit of both. The fact that they're bringing down those prices and that they're modifying the tariffs that they themselves implemented suggests a change of course, which indicates that they think they might have gone too far or made a mistake. By the same token, people, again, don't necessarily remember who was responsible for who got them into a particular position. They care about who gets them out of it. And a year out from the election, it's possible that the Republicans will be able to make up some ground on this front. But at this point, when it comes to affordability, I'd rather be a Democrat than a Republican if you're trying to convince voters that you're who can fix the problem.
When it comes to voter psychology ahead of the midterm elections, at what point does this really start to get into the psyche of talking about inflation, affordability, and linking that with the current administration?
It's funny because for political scientists and pundits and journalists, we're already thinking about 2026. The average American is not. And so both parties have several months, at least until the initial primaries in competitive congressional districts, to figure out what their messaging is and to figure out what the economy actually looks like. And most importantly, to figure out the disconnect between the objective measures and consumer sentiment and what people actually think about the economy. We've seen that people's perceptions are much better predictors of how they're going to vote and who they think is responsible than actual economic indicators. And that's frustrating often for incumbents in office who have seen an uptick in economic indicators in their favor when those indicators just haven't resonated with potential voters.
And let's just end on the midterms. You and I obviously already focused on it. If you had to tell our viewers one race to watch, what would it be?
Oh, that's a really tough question. I'm actually not sure. I think we're too far out. What I would say is that any of the districts that that Kamala Harris or Donald Trump won by less than 2 or 3 points last time around are fair play this time.
Right, so the margin's potentially going to be incredibly tight. Professor Lawless, thank you so much for your time. That was Jennifer Lawless, professor of politics and public policy at the University of Virginia. And Jonathan, she said it's a very hard needle to thread when you talk about affordability. The Trump administration is trying to blame it on the policies of the Biden administration, but at the same time, Americans are feeling it right now, especially when you have beef prices approaching $10 a pound.
Annmarie, with the latest down in Washington. Annmarie, thank you. Do you know, I really underestimated just how much the politics of New York, New Jersey and Virginia would change the conversation in this White House around affordability going into the midterms next year.
Yeah, well, they got the message. And the idea that Mamdani is now going to be welcome to the White House highlights just how much that message has changed. I just wonder how they transmit a message that is more complicated economically. And the idea that President Trump was at this McDonald's conference and said, I want to give a very special thanks to McDonald's for slashing prices for your most popular items, bringing back extra value meals. I wonder from a corporate standpoint whether this is welcome or not. And I say this because it's not just McDonald's, it's also Walmart, right? This is a president that's going to certain companies and saying, look at Walmart's Thanksgiving, looks at McDonald's Happy Meals. You know, this sort of idea of cherry picking examples, but then also putting certain companies up on a pedestal. How much is that an incentive to certain companies to make certain deals to sort of, you know, cater to that desire?
I think those companies, too, have shaped policy in this country. I'd go back to April when they went into the White House. They had a major impact, I think. An influential take on what developed for policy around trade from this White House.
I wonder if it's a tit for tat. You can go tout the extra value meals. You lower tariffs on beef. Make our fries great again. Thank you.
It's good marketing. Spotlight's on them, right? We wouldn't be talking about it. They did this ages ago.
I know, and they had this conference that I never knew about.
There you go. Now you do.
Now I do.
Equities down by 0.5% on the S&P and the Nasdaq down by 0.6. 3-day slide developing into a 4-day fall on the S&P 500. We're down by about 35 points on the S&P. For the technical strategists out there tracking a 50-day moving average, 138 sessions of holding above that level, the second longest run so far this century. Thank you very much for the team at Bloomberg News for breaking down that stat. We snapped it in yesterday's session. This is the kind of thing that makes people nervous. A 3% move off the index level. I know I've been saying the same thing. It's not that painful, but ultimately things have been so one way for so long that breaking that kind of trend gets your attention.
Yeah, and it's the worst 3-day run going back to, guess when? April. So this is the first time that we've seen this type of shift away from that 50-day moving average and just in general, going back to Liberation Day. So it raises the question, is this the beginning of something greater? Or is this just the sort of blow-off top that gives everybody a really good feeling heading into Christmas, the Santa Claus rally? And this ultimately is going to be what everybody talks about. Right now, the fact that credit is participating and that you are seeing the sort of more consumer-facing aspects raising some concerns.
Soft the tone again this morning, at least so far. We'll see if this changes as we count you down to the opening bell. 2 hours to go. Let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. Home Depot is sounding the alarm as it kicks off retail earnings. Shares are falling 3.4% after it lowered its guidance, citing a host of issues, but mainly a consumer not willing to spend on those pricier home improvement projects. Plus, they cited a weak storm season that hurt sales for things like generators. Lowe's also falling in sympathy, and a correction for me that reports tomorrow, not later today. Meanwhile, we are also seeing Microsoft and Amazon underperforming the Mag 7. Both are down nearly 2% after Rothschild & Co. Redburn downgraded the stocks to neutral, with the analysts saying that the underlying economics around generative AI are far weaker than assumed. And at a time when the hyperscalers are spending hundreds of billions of dollars on the AI infrastructure build out, the analyst there sees a higher risk that Microsoft and Amazon are overbuilding. And we end on Cloudflare. Those shares are also falling 3.75% in the pre-market on a technical issue at the internet security firm. Nearly 5,000 Cloudflare outages have been reported, according to Down Detector, and that is affecting sites like X. Earlier this morning, it showed about 10,000 reports of issues at the social media platform. ChatGPT is also being affected. Cloudflare says that it is working on the issue. John?
Yahira, thank you. Appreciate it. Just getting some extra headlines from Cloudflare. Continuing remediation efforts. Customers may still see higher error rates, so clearly the problems continue.
Yeah, the fact that you're seeing such a huge drawdown in the shares, not huge, I guess, a 4% significant decline in futures, highlights how central some of these systems are to everyday life and to business models. And it raises this question going forward, if there is some sort of systemic importance to these tech companies, what happens if one of them goes down? Remember, we saw that with Amazon Web Services.
Yeah.
What happens with Azure? What happens with some of the others? You just start to wonder, okay, well, what's the backstop to this and how are companies preparing for that?
When things like this happen, you're reminded of just how fragile the system actually is.
Totally.
That stock is down by close to 4% so far this morning. On our radar this morning, Bitcoin briefly dropping below 90K, the month-long slider raising the cryptocurrency's gains for the year. The decline coming as concerns grow over interest rate policy and stretched valuations. Elsewhere, another shake-up at Apple. The designer behind the iPhone Air is leaving the company for an AI startup. Abhidor Chowdhury's exit is making waves, given his rising profile and his appearance in a video introducing the iPhone Air. And finally, Amazon raising $15 billion in its first US dollar bond offering in 3 years to help fund its AI build-out. The bond sale is the latest in a series of massive tech debt deals, pushing global issuance to a record of more than $6 trillion this year.
Yeah, and the $6 trillion is for all corporate issuance. That said, you're seeing a massively increasing proportion of issuance over the past couple of months coming from the tech sphere. I keep reading Robert Schiffman's notes from Bloomberg Intelligence. He's really doing some great work, and he talks about how the AI debt supercycle isn't nearing the end, likely just the beginning, because ultimately these are the hyperscalers that are most cash intensive, cash heavy. They have the ability to do this. Yesterday, the sale coming out was completely oversubscribed. The 40-year piece, we talked about how the premium above the treasury rate was something like 1.1%, that percentage points. That came down to less than half a percentage point. So it raises this issue. What will cause the end of this? And isn't the debt market essentially opening the books and saying, please go for this? Because ultimately we are willing to fund it.
$94 billion cash balance. I was reading the note that came from Robert yesterday, and a potential to generate $200 billion of free cash flow before shareholder returns over the next 3 years or so. Not everyone is Amazon. Not everyone is Alphabet. And that's the question I keep going back to, really. Are we building these hopes and dreams on the balance sheets of these guys, or on the promise of OpenAI, with a revenue profile at the moment that doesn't really fit its spending expectations over the next 5 or so years?
It's an important question. Are we building the hopes and dreams of AI on the idea of efficiencies in culling data from your balance sheet, as well as just having back office support that isn't generated entirely by humans? Or is it the idea of some sort of accelerated humanity and augmented intelligence and this sort of generative AI that supersedes anything we can even imagine? Is it the hopes and dreams of something that is sort of in the realm of science fiction? Yeah. Or is it in the realm of back office processes and spreadsheets that are made more efficient?
It's such a weird moment, Bramo, when you really think about it. What OpenAI has done is basically pushed Alphabet, Meta and other companies to believe they're confronting an existential moment, which is forcing them to spend even more. They've got the money to do it. Arguably, OpenAI doesn't, based on its balance sheet. And the longer OpenAI continues doing exactly this, pushing the others to spend more and more and more, you just have this massive commitment. They're like locking horns right now, committed to overcapacity and overspending, and we're trying to work out when the music stops. Do you keep on dancing in financial markets?
Yeah, do we get to that moment of efficiency where suddenly we can justify all of these spend commitments that we see out there? Or are we kind of just all climbing and building something to infinity? And ultimately, that's the question that a lot of people are grappling with.
Another big debt sale, this time from Amazon, $15 billion in the last 24 hours. Let's turn to the continent. Over in Europe, the ECB lowering the amount of capital that it requires banks to hold after sailing through a stress test earlier this year. The move allowing banks to continue making shareholder payouts. Joining us now, the individual behind the report, the ECB Supervisory Board Chair, Claudia Buch. Claudia, welcome back to the programme. It's good to hear from you, as always. How would you characterise the state of the financial system at the moment?
Well, thank you very much. First of all, good morning, good afternoon from Frankfurt. So I would say that the euro area banking sector is in a very robust position. So capital ratios have increased. They're now at 16%, a bit higher than last year. We actually kept capital requirements broadly stable. Yes, the stress test told us that the capital depletion, which is informing our Pillar 2 guidance, would be a bit lower than it was in the last cycle, but losses were also higher and profits were higher. So this is the combined effect that we are seeing here. Broadly, capital requirements stay stable because there's a small increase in the Pillar 2 requirements. So a robust situation, good capitalization, good profitability, good liquidity positions of the banks. Non-performing loans are also at a very low level right now. But of course, we're seeing pockets of vulnerabilities, and the European banks operate in a challenging geopolitical risk environment. So this is why we always need to stay vigilant.
Claudia, do you think these banks are in a position to maintain or perhaps even increase the level of shareholder payouts? Are they telling you that they'll do that?
Well, I mean, of course, we look at this over a 3-year horizon. So this is pretty much business as usual that we also discuss with the banks, of course, their payout strategies. So what we've seen, I mentioned the higher profits that we have now in the system. And of course, also this leads to higher payouts compared to what we've seen in the previous years. But we're also telling the banks, well, look at your long-term business strategy. So what is needed to maintain resilient, to have a good long-term sustainable business model in the future? That also requires investment into IT infrastructures and so forth. So it's a balancing act, and we're seeing that roughly the banks are planning payouts of 50% by and large. But this is, of course, also differs across banks, and there's a little bit of a variation over time in there.
Claudia, yesterday Bloomberg reported that UBS was in talks to potentially move their headquarters to the United States from Switzerland if some of the capital requirements weren't lowered, as they thought that they were punitive and they were going to be raised. And I'm just wondering how much of the effort to right-size some of the capital requirements is to try to have a better competition, a better backdrop with the United States and some of the banks over there.
Well, I think you understand that I never comment on individual banks. I need to say this because you started with the case of a specific bank. So all I'm saying is just general about the capital requirements we have in the system right now. I think they're very well justified. As I said, the euro area banks are in a good position right now, but we also have risks and uncertainties that lie ahead. So that always needs to be balanced. I think generally, globally, we have with the Basel Agreement, we have very good global guardrails when it comes to capital requirements and a good framework that also internationally active banks need. And I think it's very important, in particular in these often difficult times, that we also keep this global guardrails.
How much are you keeping a focus on private credit? We know that that's been an increasing concern for a lot of banks. And you talked about how you are looking for more transparency in terms of lending to private credit investors and beyond in the Euro region. How much progress are you making? What do you see there?
Yeah. Well, we have seen definitely since the global financial crisis, we've seen a shift of activity away from the banks towards the non-bank financial intermediation sector. So we have a better resilience in the banking sector, which is good. We also have credit activity in other parts of the financial system, and we need to see how risky this is and whether vulnerabilities are building up. So we've worked very closely with banks that are also linked to the private credit markets to see what risk management they have in place. And we have also given them advice on how to improve the risk management. One of the things we are seeing is that it's often not very transparent where the risks are with regard to private markets, non-bank financial intermediation. So I think there's also a role for policymakers to improve the transparency of parts of this market. Not all of this market is intransparent, but part of it is, and that needs to be addressed.
Claudia, didn't we push the activity away from the banks? Weren't the rules that came in after GFC, isn't this the consequence of that we push this activity to places where we have less transparency? Claudia, is that a failure of the rules that we implemented after the GFC? How would you think about that dynamic?
No. I think the evidence is very clear that the rules that were put into place after the global financial crisis have really benefited the system. So as I said earlier, the banks are more resilient, they're better capitalized, it's better quality of capital. This has not come at the expense of their ability to lend to the real economy. So this has been proven over and over again by many studies. And I think we are in a much better place, both in terms of resilience and also the competitiveness of the banks. I don't think it's a contradiction. So I think the banks that are more resilient, that have a broader resilience against all the uncertainties out there, I think they're also more competitive in the long run.
There's a word that you used in this interview a few times, vulnerabilities. Can we just finish on vulnerabilities? Could you be specific about the kind of vulnerability that you're particularly concerned about, that you and the team on the supervisory board are very focused on going into the new year?
So I can be very concrete. So one of the vulnerabilities is one of our priorities for the next 3-year cycle is to make sure that banks are resilient against geopolitical risks and macro financial uncertainties. And so this is, if you take one geopolitical risk, we have, for example, seen an increase in tariffs, uncertainty about tariff policies. And not all of these higher tariffs have made their full effect onto corporate balance sheets and thereby also potential credit losses for the banks. So this is one of the issues we are looking into, and it's very clear that banks need to have good underwriting standards in the future. They also need to maintain their resilience and capitalization. So this is one of the areas we are focusing on for the next 3-year cycle.
Could I extend that also beyond just US policy and US tariffs? Are you focused on maybe an overexposure to the Chinese economy in the European banking system at a time when you've talked about geopolitical risk? That would be my number one. Not US policy. I'd be thinking more about the future of the relationship between the Europeans and China and what might happen with a place like Taiwan. How are you considering those kind of developments in the future if they potentially do materialize?
Mm-hmm. Well, my point about geopolitical uncertainties was a very general one. No, I didn't mention the US. So it's just generally, I mean, we're just in a very different environment than we used to be years ago. And this needs to be acknowledged. Look, we don't know what is the most relevant risk scenario, adverse geopolitical risk scenario for the individual bank. And this is why we will next year ask the banks to do a reverse stress test, which is asking the banks, what is the most relevant geopolitical risk scenario given your business model, given your exposures, and what could be a scenario that could be detrimental for your financial soundness. So that's the kind of question we will ask the banks, and we look forward to that information we will get from the banks. They will use their own internal capital planning tools to give us that answer. But it's not that we know what is the relevant scenario for the individual bank.
We look forward to seeing what they've got to say. Claudia, we appreciate your time. I look forward to catching up with you again soon. Claudia Buch there, the ECB Supervisory Board Chair on the financial system in Europe.
I like that, the reverse stress test. Tell us what you're most focused on, because ultimately, geopolitically, it's changing at any given moment. And when you talk to banks, they might have a very different view than the supervisory boards that often have been looking at past crises and where that comes out.
Nothing to see here. Everything's okay. I imagine is going to be the response now.
You think so? I think that they might raise some issues in terms of banks, in terms of some of the security that they'd like to see.
The phrase geopolitics drives me nuts when it comes to financial executives. Be specific about what we're talking about here. What are we talking about? Geopolitics. What does that even mean? I think that's just a term that we throw around now. Let's be really hyper-specific. For the European banks, I'd want to know what would happen in the same way we had to sever the relationship with Russia. What would happen to the Europeans if we had to sever the relationship with China? Isn't that like the number one dominant geopolitical risk out there?
I love that you're giving your reverse stress test. This is it. I think that's
we should enforce that on the banks.
Well,
I think what would you do?
You're going to bring that up to the fore. But I think
into the Russia situation. We're going to sleepwalk into the same situation with China.
How do they deal with the same type of situation? Where do they provide credit? What are their sort of know your customer types of protocol when it comes to some of these places?
Totally. I mean, you think about the policies coming from the US right now. Maybe the secondary sanctions from the US on the likes of India and China. These are all things you've got to think about. Anyway, save it for another day. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Yahira with more. Hey, Yahira.
Hi, John. Bank of America's monthly fund manager survey found that investors' cash positions have dropped below a key threshold, triggering a so-called sell signal for equities. Average cash held by fund managers fell to 3.7%, something that's happened just 20 times since 2002. The survey ranked a potential AI bubble as the biggest tail risk, while investors also said that companies were over-investing. Meanwhile, Federal Reserve Governor Lisa Cook making her case against allegations of mortgage fraud, calling the claims, quote, baseless, and saying the contradictions were incomplete snippets of full documents. The U.S. Supreme Court is set to hear arguments in January on President Trump's move to fire her. And speaking of President Trump, he touted his economic policies last night, saying they have drawn trillions in new investments to fuel private sector job growth and ease inflation. Speaking at the McDonald's Impact Summit, the president thanked the fast food chain for slashing prices for its most popular items and bringing back extra value meals. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks very much. Up next on the program, funding AI ambitions.
The scale of spending is so massive that the market is effectively putting a 100% probability that this is going to be truly transformational.
Herr of JPMorgan Asset Management joins us next. Live from New York City, welcome to the program. Under surveillance this morning, funding AI ambitions.
Nobody knows, which is a fact, as to what the true profitability will be. And that is important not in itself because the scale of spending is so massive that the market is effectively putting a 100% probability that this is going to be truly transformational. Going forward, given the scale of spending, increasing the credit markets are going to be tapped.
So here's the latest this morning. Amazon joining Meta, Alphabet, Oracle, all with multi-billion-dollar bond sales to help fund AI build-outs. Herr, the US global fixed income currency and commodities CIO at JPMorgan Asset Management, joins us now for more. Good morning. Good to see you.
Good morning, John. Glad to be here.
50-year debt from Alphabet, 40-year debt from Amazon. What are these guys up to, and why do investors want a piece of it?
So I think the first thing to remember is these are highly rated companies with a lot of free cash flow. If you think about the 5 hyperscalers, most of them have enough cash on the balance sheet to pay for this debt. It's the opportunity, though, to put debt in the markets. Yesterday, the investment-grade credit market had $26 billion of new issuance, all of which absorbed very easily. Initial price talk on the Amazon deal yesterday was 25, 30 wider of a concession. It ended up pricing pretty much on the screws and traded there. So there's a lot of demand for fixed income here at these levels.
Even for 40-year tranches? I mean, what do you make of the 40 and the 50-year pieces of some of this debt?
Look, I think when you think about this, you're going out a long time, and the question about the returns that companies are going to generate for this, the AI investment, it's awfully uncertain. But I think these companies have a lot of cash flow. They can repay the debt. I think I would be more focused on the multiples that are paid in the equity markets than on their ability to repay when they've got cash on the balance sheets, Lisa.
The best way to say check your own house before accusing the debt markets of being
I think maybe
prolific.
so.
Yeah, you think that that's what's going on?
That's right.
I just wonder if there's a better story to tell, maybe in either speculative grade credit or outside of the U.S., where you are more insulated from some of the tech story, because even if these are highly capitalized companies, the whipsaw in sentiment around AI seems to have driven a lot of the movement recently.
So I think if you look at the bond market's holding up okay. Look at yesterday or the last few days, you've had a sell-off. Bonds are actually doing what they're supposed to be doing, right? Think about it. The ag's up almost 7% this year. Bonds are delivering stability, diversification, liquidity. I know it's boring and old-fashioned, but that's kind of where we are.
Is that just a U.S. bond story, or do you see that across sovereigns?
No, I think that is true more broadly. I'm obviously much more focused on the U.S., but I think broadly that is true. Bonds are doing what they're supposed to be doing here.
We've had a 40 basis point plus move on the year. I think on the US 10-year, we're down another 4 basis points this morning to about 4.1%. Some convulsions, I've used that word a few times in the last 24 hours with regards to fixed income. Some convulsions in JGBs. What's happening at the long end of the JGB curve? And what's the potential spillover into global markets?
So I think you've had some geopolitical uncertainty in the JGB. You've got a new prime minister out there, I'm on TV. You got to be careful what you say, because if you're going to use the word convulsions, people can make a lot of interpretations.
I use the word convulsion.
Yes.
You don't have to. Is there a potential, though, to re-anchor global bond yields higher, given what's developing in the Japanese bond market?
There's always a potential for higher. There's an equal potential for lower. I mean, every day there's a market made in this. I mean, look at the Fed or look at pricing on the Fed. I think the last time I was here, it was almost 100% certainty that the Fed was going to cut another 25 basis points. Here we are. That's now below 50%. And so there's always a market to be made in these, in buyers and sellers.
Do you think the risk is balanced into that Fed decision?
I think the market is pricing it pretty much balanced. I think the probability is now below 50% today. But we actually think the Fed's going to continue. We think the Fed cuts again in December.
What's going to deliver that move? Another weak jobs report?
So it's funny. Yesterday, one of my trustees was in and reminded me that they always call us bond ghouls. We're bond ghouls. So bond ghouls, we can complain about anything. So we spent the 60-something days of the federal government shutdown complaining that there's no data. And now we're obsessing because there's data starting. We get ADP at 8:30. We get non-farm payrolls on Thursday. So I think if you look, the data is going to be anything you want it to be, right? We're going to get a September number on Thursday. Consensus is 57,000 or whatever it is. But you all know that the margin of error for economists on those non-farm payrolls is plus or minus 100,000 jobs. So it's going to be interesting to see what the Fed does here.
I'd forgotten about ADP. We get the weekly number later this morning, right?
8:30 this morning,
there we go.
Get ADP.
That's your promo from Herr of JPMorgan Asset Management.
Don't chase this market. Let it come to you.
The question isn't, will the market be healthy, but will it remain bifurcated?
There are legitimate questions about valuations.
I do think that the market is too negative on the economic outlook.
If you get any more downdraft in technology, it's going to be hard to rally through the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. We're pulling back again near session lows, down by 0.6% on the S&P, down by 0.7 on the Nasdaq, down by 0.75% on the Russell this morning. The earnings so far from Home Depot, not great. The outlook, not great either. Teeing us up for Walmart and Target later in the week.
Yeah, and it really highlights, is this just a housing-specific or housing-related issue? Big-ticket items usually associated with renovations that might plague Lowe's tomorrow and certainly did seem to hamper some of the Home Depot earnings. Or is this a broader consumer issue that you're starting to see percolate out into the shares of certain travel stocks? And you are hearing in some of the commentary. That's the reason why Target and Walmart are going to be so important. How much could they pass along price increases? And how much do they see the acceleration, the reacceleration in the underlying economy early next year that so many people are banking.
They don't see it going into year-end based on what we've heard from Home Depot so far. Are we going to see it in some of the data? September payrolls, the estimates keep pouring in. We've got about 19 economists putting out estimates right now, and the median estimate is 65K. 65K, based on what we've heard on Wall Street, is a pretty decent number these days. You get 65, it's going to feed that belief that things are starting to pick up again.
This is really the crux of the issue. 65 wouldn't have been good 2 years ago. Right now, it sounds really good because some people are saying that the total number of jobs needed to break even based on the immigration is significantly lower. You will get other people saying, no, this is a shell game. This is actually a very poor economy. And take a look at the overall hiring of new graduates, and you can see the pain. You can paint the own story that you want. We will get ADP data, as we just found out from Kate later this morning, that could potentially, later this hour, that potentially will give a color heading into some of those numbers.
8:30 Eastern time for the weekly ADP. TD Securities looking for 125 this week for September payrolls. For whatever that's worth, 125 is the high estimate.
So if it is high, how much are people going to explain that out by catch-up from over the summer? And how much does that really point to forward-looking strength? I mean, really, you can paint whatever narrative you want, especially given the fact this is September data, and we're going to get very messy October data that everyone will obsess over, and at the same time will be considered irrelevant because we're not getting an unemployment rate. So, I mean, ultimately, it just gets messier and messier.
Super noisy October, maybe even a noisy November, and a Federal Reserve that sits there with no clear data. So what do you do? Governor Waller making a case yesterday afternoon that you cut interest rates and essentially communicating there is nothing that can happen between now and December 10th that's going to stop him from voting for a 25 basis point reduction.
Yeah, and this, to me, is really a question. How entrenched are Fed opinions across the lines, right? There are sort of the centrists who are undecided and say it's going to be up to the data. We hear that from Mary Daly. We also heard that from Neil Kashkari to some degree. And then you have people like Chris Waller who are going to cut rates. You also, of course, have Stephen Myron who will cut rates. And then you have others who have come out and really seem to not want to do that. Lori Logan, for example, or Beth Hammack. So you can see the lines shifting. It's sort of like a Supreme Court, right? It's sort of like one flank here, then the centrist that potentially could be skewed either way.
Fallen off the radar a little bit. Should find out who the new Fed chair is before year end as well.
Yeah, that's
kind of fallen off the radar into year end, but that could change the debate about what you might expect to happen in 2026. This morning, in 2025, equity futures a little bit softer. Bond yields lower by 5 basis points through the belly of the curve. On 10s at the moment, we're down about 4 to 4.1%. Coming up this hour, we'll catch up with Lisa Shalett of Morgan Stanley Wealth Management as the tech rally retreats, Stephanie Roth of Wolfe Research as Labour data trickles in, and Jason Tyler of Northern Trust not yet seeing an AI bubble. We begin this hour with stocks sliding on valuation concerns. Lisa Shalett, CIO of Morgan Stanley Wealth Management, saying the following: while the 26 bull case remains intact, there are some headwinds from the affordability crisis and growing pessimism in the labour market. Lisa joins us now for more. Lisa, good morning.
Good morning.
It's good to see you. Not just about AI, not just about big tech.
It is not. It's about the K-shaped economy. It's about that consumer, the lower end of the K, and this idea that consumer sentiment, it's not even their behavior at the minute, it's this sentiment is so negative. To the question in the University of Michigan, what do you think job prospects are in a year, right? We're at the worst reading since 1980. Folks are really depressed about the potential for the job market. And it's not just cyclical, I think. It is this hand-wringing about, the secular story of Gen AI.
I think we've got to stay on that. 45 years of events. Just think about everything that's happened, GFC, the pandemic, and you, Mitch, is telling us, the consumers are telling us that this is the worst they've felt about the labour market across all those things that have happened.
Yes.
That's bonkers.
It is.
What do you think is behind that?
I think it really is this existential fear. I think it starts with what they're observing, as Lisa noted, with new graduates not being absorbed into the labor force at the normal rate. But what they're seeing at the workplace and all the visions of how I'm going to be automated away, whether it's from, the robotics end of it, right? If you're, a physical laborer or if you're a knowledge worker from, an agentic entity or an agentic bot.
Do we have to have that kind of future where in some ways robots take over humans in order to justify valuations where they are?
I don't think so. Our take has been, here we are, there's 153 Americans working in the United States labor force. The U.S. Stock markets are the envy of the world. We're, within 2 to 3% of all-time highs. Our profit margins and our returns on equity are at historic highs. This is, as we were talking about before we got on air, some of this is the technology is here, and is this, a solution in search of the problem? I don't find a lot of people saying that America has a profitability problem.
Well, so Dan Pinto of JPMorgan, Daniel Pinto, came out earlier this morning and was talking about this and said that there probably is a correction that has more to go, particularly with respect to AI, and said that in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing in now. Is that how you see it as well, that there needs to be some sort of retracement, that potentially these are the stocks that could trade sideways for months, if not a year, before the use cases grow into some of the valuations?
I'm in that camp. I know some of my compatriots at Morgan Stanley are not. But, what's built into the 2026 earnings forecast already is about another 130 basis points of margin expansion and productivity gains. That is a lot of productivity gains in 1 year across an economy. And so our best guess is that next year the earnings will be decent, and decent to me is up 5 to 10%. But things that border on 15 to 20% is a push, because it's a level of productivity that I just don't think the American workforce is ready to deliver, let alone embrace.
Can U.S. stocks outperform if you don't have the AI names leading the charge?
I actually think that they can. And the reason is that I think that there have been huge portions of our market that have been squeezed out or forgotten, right, over the last 15 years by, this huge tech leadership. In fact, our best guess is that next year we're going to see some nice return in leadership to financial services as, we get deregulation and animal spirits returning to markets, healthcare, energy. So we do think that there are places to make money in this market, that new leadership can emerge or at least challenge some of these tech leaders. And that to me is a very healthy stock market.
Lisa, could you describe what's happening and what the starting point is going into 26? So we've seen a 3% decline at the index level on the S&P. How much damage is there beneath the surface away from big tech?
So there has been damage. Obviously, we've seen it, in some of the more macro sectors. We're seeing it in cryptocurrencies. Obviously, there's some pain. So we do think that there are opportunities. Like I said, we'd be picking through, some of the financial services stocks, some of these consumer stocks, some of the healthcare stocks have started to recover here. So there are lots of things to do.
What needs to go right with consumer discretionary into next year?
So I think the fundamental thing that needs to go right is that, some of our worries and the fears about both the job market and inflation need to kind of tamp down, and we need to see decent income growth for the bottom half of the K to, quote unquote, hang in there.
How much do we need rate cuts? Significant rate cuts?
So it's an interesting question. I think, the small to mid-sized business sector, parts of private credit, I think need close to 200 basis points of rate cuts. The key thing is we're probably not going to get it. And that's why there's a little bit of this current dance that we're doing with the Fed, I think, which is kind of moot. It's like, what's the difference? Another 50 basis points? Who is that helping and who is it hurting? If anything, it's just kind of steepening the long end of the curve, which doesn't help your housing market.
Lisa Shalett, it's good to see you. As always, thank you. Lisa Shalett there, CIO of Morgan Stanley Wealth Management. 50 could do more harm than good.
Yeah, the idea that it steepens the curve and it leaves the mortgage market in even more pain. The idea that private credit needs 200 to perform highlights the gap right now in perception versus reality, and is part of what's fueling some of the angst that you're seeing reflected in equity shares.
You want to drop the front end aggressively. The balance sheet needs to do some work to cap the long end of the yield curve. With inflation closer to 3, then than 2.
You mean yield curve control is sort of the inevitability? That's what people think.
Maybe. I would love to get some insight on the interview questions.
We're monetizing the debt. Here we go, baby.
Is that what the dollar story? Is that what the dollar story was picking up on at the start of the year?
100%. I mean, Scott Bessent knows what he's doing. He's just going to jam it. He's going to buy it.
You expect another round of that next year? Another round of dollar weakness?
Yes, I do. Again, I know my compatriots at Morgan Stanley have moderated their view and said, they think the dollar's flat next year. But I do think we're going to have another bout of it, especially, no one's talking about this, but, Trump's throwing out there that, hey, I'm giving everyone the tariff bonus check. Well, weren't the tariffs over 10 years supposed to pay for your tax bill? Wasn't that the whole point? So let's see. You had a regressive tax. It's called tariffs. And now I'm giving you the rebate of the money I took from you?
I'm keeping track. I'm trying to keep track. Lisa, you keep bringing me back. I'm trying to go. It's good to see you. Thank you. Lisa Shalett of Morgan Stanley, everyone. Equity futures on the S&P down by 0.4%. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. AI cloud startup Lambda said it raised over $1.5 billion in its latest funding round. The company, which rents out access to advanced AI chips, plans to use the capital to buy additional NVIDIA GPUs and build its own data centers. Its sights are set on moving from being a data center tenant to an owner, having raised $2.3 billion so far in total funding, with plans to hire engineers and operators. And Bitcoin has wiped out all of its gains this year as investors' risk appetite sours. The currency fell below $90,000 for the first time in 7 months, though we are trading above that now. The drop comes as interest rate policy uncertainty and stretched valuations weigh on broader markets. And President Trump doubling down on his call to send checks to Americans to cover healthcare costs. Trump posted on Truth Social earlier, the only healthcare I will support or approve is sending the money directly back to the people, with nothing going to the big, fat, rich insurance companies who have made trillions and ripped off America long enough. That's your Bloomberg brief. John?
Yahara, thank you. Thank you very much. Up next, the Morning Calls Plus, John Lovallo of UBS, as the housing market faces significant headwinds. That conversation just around the corner. Live from New York City, you're watching Bloomberg TV.
As the small business data starts to hit the economy, that's where we're going to realize, wow, this is where the jobs are. And that would probably fit very well with Home Depot type of thing, right? That's the small contractors, right? Those are the ones who are struggling right now. I think the economy is worse than we realize. I do think the Fed should cut because I think that data is going to show up weaker and weaker.
That's an argument we've heard from Governor Waller of the Federal Reserve, an argument we heard earlier on this morning from Peter Tchir of Academy Securities. If you're checking in for the price action, here it is. Equity futures on the S&P 500 down another 0.4% on the Nasdaq, down by 0.5. As the price action, here are your morning calls. First up, Redburn downgrading Microsoft to neutral for the first time, calling the industry's Gen AI narrative increasingly misplaced. The stock is down by 1.7%. Your second call from Loop Capital, upgrading Alphabet to buy, saying a wall of worry has been obliterated under AI enthusiasm. That stock is up by another 1.1%. And finally, Stifel raising its price target on NVIDIA to $250 ahead of earnings tomorrow, viewing NVIDIA as best positioned to benefit from AI compute demand. The stock is down again this morning by 0.9%. Let's stick with earnings. Home Depot cutting its full-year guidance in another warning about the strength of U.S. consumers. The company also reporting comparable third-quarter sales that missed estimates. Drew Redding is tracking the story, and Drew joins us now for more. Drew, not a great outlook from this company, not great commentary either. What was your take?
So, I think the challenges facing Home Depot are pretty well documented. You have heightened consumer caution. You have a weak housing market. This quarter, they're lapping some storm-related activity from last year. So certainly a lot of challenges. I don't necessarily think the results today reflect a sharp reversal in the business. I still think the core underlying trends are probably pretty stable. I think the problem is that things aren't getting better. I think people are looking for that inflection in home improvement retail, and we just haven't got it. And as you mentioned, the commentary going forward is certainly much more subdued. So I think that's really the issue, is that things aren't getting better yet.
They aren't getting better even with an easing of mortgage market conditions. And Drew, that's what stands out for me. And to read the line verbatim from the CFO, we'd expected demand to begin accelerating gradually in the back half of the year as interest and mortgage rates eased. But that hasn't happened. Drew, why do you think that hasn't developed? What's happened to the relationship between mortgage rates and what happens with a company like this one?
Yeah, that's a great question. And, we've been saying for a while mortgage rates get all the attention, they're obviously a key component of affordability. They're not the only thing that's impacting the housing market. If it were, we'd have seen the builders do a lot better. We got some data on the new home market yesterday, which showed applications to purchase new homes down from last quarter, down 3% from last year, and well below seasonal norms. If you think about what the builders have been doing, they've been getting their buyers rates in the low 4-5% range, so much better than what we're seeing, at the headline. So I think what that tells us is that it's not just rates, but it's really consumer caution. You have consumers who are more concerned about the direction of the economy, more concerned about the labor market, and when you have those type of concerns out there, there's certainly more hesitation in terms of spending, particularly as it relates to Home Depot and big ticket discretionary categories like kitchen and bath remodels and flooring projects.
Stock is down in the pre-market by close to 4%. Drew, appreciate your time this morning. Thank you, sir. Drew Running there of Bloomberg on Home Depot. John Lovallo saying home builders and building products over at UBS, saying he's still bullish on the setup for the home builders heading into 26. However, we're definitely concerned about consumer confidence and employment. John joins us now for more. John, good morning. Good to see you.
Hey, John. Good to see you.
Thanks for dropping by. What's the relationship between, say, a Home Depot and the companies that you cover?
I think it comes down to what Drew was saying. It's consumer confidence. I mean, we still believe heading into 2026 that it will be a better year for housing than 2025. But consumer confidence and unemployment are big headwinds. Now, on a positive front, if we want to think about the other side of the coin, you have inventory levels that are a lot better across markets. Intent to buy is still very high. Valuations are compelling at 10 times earnings. And really, I mean, the building blocks sort of underlying a recovery feel like they're coming together. But it is going to take that consumer confidence to improve.
So a lot of people say that to solve the issue of home affordability, you have to build more. But we see right now, as you said, the inventory problem seems to be getting better. And a lot of house builders have actually struggled to sell the homes that they've been building in certain parts of the country at the prices that they want. How much is this everyone hoping that people can just get the ammunition to meet the prices where people actually want to sell right now?
It's a good question. So I think that, again, intent is very strong. People want to buy. 37% of respondents to our survey said, hey, look, we want to buy over the next 12 months. That compares to the 30% average. It is the ability to pull the trigger. And I think that the folks that are out in the market today are well-financed and able to actually transact. It's just, is this the right time to do it? I feel like the purchase decision is sort of being put off, if anything else.
So I guess that what I'm trying to get at is how much is this trying to solve the problem without housing prices going down? Because ultimately there are a lot of people who have a stake in the ground who don't want housing prices to go down, but they would have to ultimately go down to make this housing market more fluid, or mortgage rates would have to go down so much that people can get money more or less, not for free, but for much more cheaply so they can lever up.
So I'm not sure you're going to see either. I don't think we're going to see mortgage rates come down significantly. I'm not making a call on rates, and that's above my pay grade. I also don't think that you're going to see home prices fall. There's just not enough inventory in the market. What I think the government really should focus on is kind of improving the cost equation for the builders, the ability to get more sort of supply at a lower cost. If you think about it, the housing industry is the only industry that I can think of in the country that has had negative productivity since 1987, right? So we need to actually invest in technology and infrastructure in order to make the process more fluid.
Can you give us an example of that?
Yeah, we actually did a 3-year study, believe it or not, on just wall panels alone. And wall panels, so building wall panels within a manufacturing facility and bringing them out to the job site, cut the actual framing days by 30%.
So closer to prefab homes?
Closer to prefab homes.
Seen some of that develop in Europe. I've been seeing some of those houses put together. They're very attractive as well, but it's quite niche, and they're quite expensive too, because I don't think they're doing sort of mass market homes. I've seen some come out of Germany. They cost a fair amount of money. What kind of technology are you seeing develop that can do things on a bigger level, a greater scale?
So I think there's two different ways. You can do complete off-site construction is what I'm getting at, is doing more than the wall panel. So it's the roof trusses, the floor joists, and et cetera, bringing them out to the job site and actually constructing. I saw a home that was fully framed from, basically up to plate level in 3.5 hours. It was just remarkable. The other way you could go is just manufactured housing. So, homes that are built completely in the factory and brought out. This Road to Housing Act that's just recently been passed by the Senate is trying to kind of move that along. There's a couple different things in there that could help these homes get better financing and better acceptance by consumers. So there are some things in the works that can help.
Isn't the goal to bring down the price of some of these housing, yes, for the home builders, but also for the end consumer? I mean, I guess that I'm wondering how this all gets down to the idea that prices don't have to go down and won't go down in housing. But these are all measures to create more supply more cheaply that can be sold at a much lower price point, no?
Well, I think it's a function of helping on the supply side, yes, so helping the builders to reduce the cost so they can put more affordable housing into the market. So, yeah, you can mix down, but not necessarily, deteriorate the equity that's built up in people's homes.
It's funny, isn't it, John? Because these ideas have been around for a long time.
Yeah.
What's taking so long to get it off the ground?
It's an industry that's been reluctant to change, not that dissimilar to the auto industry before the 80s when the Japanese came in and revolutionized things. And so I think we need that catalyst. And you know what? This may be the catalyst. We're just in a crunch right now for housing.
Do we have enough time? And by do we have enough time, I mean, does Washington have enough time? Because they operate on 4-year political cycles, and some of them shorter cycles than that. Do they have enough time? Are these the kind of things you can implement and see results in a year, in 2 years?
No. So I think what they need to do on a near-term basis, there's a couple things they could do. One is the GSEs, which are under conservatorship, they could buy MBS for their own portfolios. They could do more of that. That could help reduce the spread. Also, tariffs. There's about $9,300 on housing, a house alone in tariffs. I mean, those are the things that could help, in the immediate term. Longer term, the things that we've been talking about could help. Also some of the ideas that the government has thrown out in terms of reducing restrictions across, municipalities in terms of building. That's all longer term, type stuff. So, no, that's going to take time.
It's a lot of work to be done. John, appreciate your time. Thank you, sir. John Lovallo there of UBS on the housing market.
Yeah, it's going to be a very much political discussion because ultimately this goes to the economic question that we're seeing raised by Home Depot, which is, can you have a reaccelerating economy with the housing market not participating?
Coming up on the program, we'll catch up with Stephanie Roth of Wolfe Research as the labour market data continues to drip out. Plus, Herr with your morning movers. Ama Sports surging as athleisure demand bounces back. The opening bell about 60 minutes away. Equities pulling back by 0.5 on the S&P 500, down by close to 0.7% on the Nasdaq. So the weakness continues into day 4 on the S&P 500 with some morning movers. Let's cross over to Herr for more. Hey, Herr.
Hi, John. We start with a big mover to the upside, and that is Ama Sports. Shares are rising 11% after it lifted its full year guidance. People are touching grass and experiencing the great outdoors, and that is helping lift demand for its hiking shoes and its brand Wilson, which of course makes tennis gear. And given there has been so much negative sentiment around the consumers, the results really did come as a surprise, helping lift shares strongly this morning. Meanwhile, we are seeing Home Depot shares falling 4% now in the pre-market. They lowered their full year guidance, blaming a host of issues, but mainly a consumer that is wary to take on those big, pricey home improvement projects. They also said that a weak storm season hurt sales for things like generators. We'll see if Lowe's, which is reporting tomorrow, confirms this weakness. And we end on the chip makers also seeing some weakness this morning. Nvidia, Micron, and AMD all in the red. The names really at the center of the AI build-out as concerns continue to mount over an AI bubble. While there is no single catalyst today, we have just seen this continued nervousness. We saw that yesterday with the announcement that Peter Thiel sold his entire Nvidia stake, all leading up to the make or break moment this Wednesday when it reports earnings. John?
Herr, thank you. Appreciate it. Appreciate touching grass as well. You touch enough grass? Get in touch with nature.
Wasn't that the mayor? No, it was the governor of Utah telling us to touch grass. I touch grass. Do you touch grass?
Not enough of it.
I think I'm a better person as a result.
Much calmer, more relaxed.
I take off my shoes.
More in tune with nature, apparently. Okay, let's get back to this market, please. Let's get you some ADP numbers. Why are they always late? Enda Curran has more. Enda, good morning. What have we got?
So they fell an average of 2,500 a week into 4 weeks to November 1. John, that's the headline coming from ADP right now. On the one hand, that's a soft number, but it perhaps maybe suggests that the pace of those losses is slowing a little bit. Remember, it's a new data series. We're trying to get our heads around this. But the bigger picture is it builds into what's expected to be an important week for giving us more broader detail on the jobs market. ADP detail today. We're going to get non-farm payrolls on Friday. Expectations there for maybe around 50,000 odd jobs gained in the month. Unemployment rate staying stable. But both indicators, ADP today and payrolls on Friday, are all expected to lean into what's expected to be an ongoing soft labour market for the time being at least.
Massive range on estimates that I'm seeing, and these estimates keep changing. So Citigroup's at 105, so that's Andrew Hollenhorst. This is for payrolls on Thursday. And at the lows, Scotiabank at negative 20. And if you're at the central bank, the Federal Reserve, going into the December meeting, you've been told you're not getting an unemployment rate for the month of October. I don't know what the November jobs report's going to look like. How useful is September and September alone, together with a high-frequency read from ADP and some jobless claims that seem to be OK?
Yeah, it's an interesting time, John. So the September data should be somewhat clean, as you know. But again, that's so far in the rearview mirror now. The October data will be much choppier, as you just explained, obviously complicating the picture for any central banker or policymaker in this. The partial indicators are all interesting too. You know, we've had an indicator this week of advanced notices on layoffs surging over the month of October, combined with the anecdotal headlines from companies letting go of staff. It's all, while it's a mixed picture, it all seems to be leaning towards, at the very least, a softening labour market. And by the way, last night we had a very interesting speech from Fed Governor Chris Waller, who really dismissed the idea that they're flying blind or going through fog. He said the data is clear, the anecdotal evidence is clear from private sector and everywhere else, is that the jobs market is softening, it is weakening. He's hearing that companies are moving from this phase of no hiring, no firing to moving into the firing phase, and that's why he wants a rate cut in December. So, yes, complications around the data, but some people are very clear-eyed on this, including Governor Waller, for example.
And thank you. Enda Curran there of Bloomberg. That speech from Governor Waller yesterday afternoon suggesting he's going to vote again for another interest rate reduction on December 10th. This came from Nita Richardson of ADP. Let me share this with you. New hires are a larger share of employment. I'll read some of what Nita had to say this morning. Hiring has slowed from earlier in the year, so one would think that new hires, which we define as workers added to an employer payroll in the last 3 months, would be a shrinking share of the workforce. Instead, they're on the upswing. So what gives? Nita says in October, new hires accounted for 4.4% of all employees. ADP payroll data shows up from 3.9% a year ago. This growing share of new hires would seem to run counter to the slowed pace of hiring. That contradiction tells us a lot about today's jobs market, and the conclusion is that new hires typically fluctuate with the business cycle, but the aging US workforce means that demographics have begun playing a bigger role in hiring decisions.
Yeah, that's her takeaway, exactly that employers are taking on a bigger share of new hires, even with the slowdown in the jobs market. But that suggests more workers are heading for the exits, meaning retiring, et cetera, because of the aging demographic, which highlights just how complicated this labor market is. This looks like a negative number, and at the same time, under the hood, you could see this churn with people maybe leaving, other new people coming in. The one caveat to that is that pay isn't exactly accelerating for some of these new hires. So it's not as though it's an incredibly asymmetric market with a lot of new hires getting a lot of amazing offers. Nonetheless, not exactly dead in the water the way that some people might describe it.
We need some more data, and we'll get that data on Thursday. Stephanie Roth of Wolfe Research looking for a solid 60,000 payrolls on Thursday's jobs report, writing the hawkish Fed narrative may persist through the report, but the narrative may change a bit with subsequent data that's likely to be more mixed. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Let's start with September. Why the bounce back? What are you looking for?
So we should see a bit of a bounce back in the sense that the trend over the summer was probably not the real trend. So we think not only will September be decent, but you also will probably get some upward revisions to August. So the 29,000 3-month average could easily look like something in the 60s. So that would be a much different trajectory because there was seasonality problems over the summer. There was significant tariff uncertainty that has started to fade. The comment that you made about perhaps we're starting to see a bit of a pickup in terms of the job market in the month of October seems like a trend that we expect to persist in the next couple months, where you might start to see cyclical industries start to hire again.
So pair that with consumer confidence that's dead in the water, with people feeling really bad about their job opportunities, with the slow pace of hiring and wage growth, with the Chipotles of the world and the Sweet Greens, and this morning the Home Depot. How do you square a story of accelerating growth with what we're hearing from companies and what we're hearing from consumers?
Well, this is growth turning at the margin. It's not as if growth is picking up to a very high pace. For 2026, we put out our outlook. We're looking for 2.1% growth, which is just above trend. And then at the margin, you're probably like to see the low-end consumer get a bit better. It's a price level problem, though. A lot of people feel bad about the level of prices in the economy, and that is a hard problem to solve because prices don't fall in the economy unless you have a large recession. So the administration is trying to put together policies that will bring down the level of prices, but that's just not realistic in this environment.
So this goes to a paper that you wrote recently about how Washington can't do this overnight in terms of the cost of living. What do you think then is going to be the solution? Do you think that it only can be driven by a recession, or that there are other marginal kind of efforts that could happen to bring down at least some of the inflation, if not the price level?
You're probably not going to bring down the price level. And certainly we shouldn't be hoping for a recession. So the best case scenario is that you grow into the price levels, in that you have a couple of years where wage growth is a little bit elevated. You start to see a bit of a pickup, call it a little above 4%, and then prices remain largely steady. So you don't really see a big pickup in prices and you kind of grow into the economy. At the same time, people then might forget about the prices as they were before the pandemic. I think that's part of the problem. People remember what prices were before the pandemic, and they don't necessarily take into account the fact that their incomes have grown about 29% since the pandemic as well, but they do see that prices have gone up pretty significantly since then.
Do you think that the risk then for the Federal Reserve is cutting rates could actually reaccelerate inflation in a way that goes counter to this?
Yeah, I think that is a risk, especially when you're talking about house prices is probably one of the areas that's the most unaffordable today. If you see a big reduction in rates, and if the government tries to put in place policies like the GSEs buying more MBS, and that lowers mortgage spreads, you might see prices start to pick up as a result, and that's a challenge. By the way, $2,000 stimulus checks, that would have the same result.
What is a big reduction in rates? Because some might argue we've had one, 150 basis points since September of last year, and housing and shelter costs aren't on the rise in a way that some people might anticipate. So what is a big cut to interest rates?
Well, I would say it's more a reduction in rates at the same time the economy is starting to pick up. The fall in rates that we've seen recently has been because the economy has slowed down. So
Important distinction.
Exactly.
The jobs growth that you'd anticipate alongside with that growth, just describe 2026 for us. Because 2025 has actually been, people talk down growth for 2025. Growth hasn't been that bad in 2025. What's been bad is the employment growth. Why is 26 going to be different?
So it should be a little bit better. We're talking, our forecast is for 80,000 payrolls growth for next year. It's not as if it's anything compared to what we've seen in the last couple of years. But relative to break even, or the break even pace, our estimate for 26 is about 70,000. For 25, it was closer to 50,000. And the reason is because immigration was a lot stricter in 2025 than we expect for 26. Still should be strict, but less so at the margin. So we're talking about a payrolls number that's not that strong historically speaking, but better than it's been.
If you do see some sort of reduction in the tariffs, and we've seen some marginal types of moves around bananas and coffee and things of that nature, if there is a more significant rollback of certain tariffs, do you think that that would reaccelerate the economy in a more meaningful way?
Yeah, it certainly could. The challenge with that is also then you might start to see rates rise at the same time, because then you'll have an environment where people might be a little bit more concerned about the deficit, and at the same time you're just having natural growth acceleration. Fed cuts would have to get priced out. So that does pose some challenges, but I think there's the possibility that we'll see an environment where tariffs get rolled back marginally. But what we've seen recently is it was on some ag products. So I think what we'll see is the occasional tariff relief, but not enough to be needle moving in terms of the economy.
Can I ask you if your view changes with the incoming Fed chair? When you find out who the new Fed chair is, how much does that move the dial for you?
So our expectation is Hassett, even though we prefer Waller. If we end up getting someone like Hassett, I don't expect that the committee will change so much. It's a committee of people that are very divided at the moment, and that's likely to even grow if we have a chair that's seen as much more dovish than the rest of the committee.
We prefer Waller. It's interesting. I don't usually hear language like that from economists on Wall Street. Why would you prefer Waller, Governor Waller?
He's a much more independent thinker. He is very data driven. He's just somebody that the market very much respects, and I think that would be a good candidate given the sort of the list of
kind of
the people
implies
out there.
that Kevin Hassett is not the NEC director. Is that fair?
That's fair.
What gives you that impression?
He, Myron, their comments have been suggesting that, you know, rates are a lot more, should be a lot less restrictive than they currently are. Their commentary is just much more in line with what the president wants to hear. And Waller is somebody that's been long respected by the market. He's had views that are very much data driven. Yes, he's been more dovish recently, but it is backed by conversations around the labor market having slowed down, concerns around layoffs picking up, which is all very fair and solid arguments. I'm a little less concerned, but the market, I think, would very much cheer having him as the next chair.
You're not alone on this point. Talk to a lot of people around the Federal Reserve who have made the same point. In fact, they go one step further. If the president wants lower interest rates, he'd be better off by getting Governor Waller, because he'd have more chance to influence the rest of the committee to come along with him and deliver lower interest rates.
Chris Waller is considered more credible in markets as an independent thinker, as Stephanie just said. There also is a feeling that he isn't necessarily going to take orders from President Trump, and so people will view it more credibly on the committee as well. He has a longstanding history there. I wonder how much that's going to be taken into account when choosing the Fed chair.
Stephanie, good to see you. Thanks for sharing your thoughts. Stephanie Roth there of Wolfe Research with an update on news worldwide with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. ADP's weekly jobless claims report shows that U.S. private payrolls fell an average of 2,500 per week over the 4-week period ending November 1st. It's a shallower drop from last week's figures, which showed a decline of over 11,000. ADP indicated that despite hiring having slowed from earlier this year, new hires are actually on the upswing. Meanwhile, the U.S. is expediting visas for foreign visitors with tickets to the World Cup. President Donald Trump said government agencies are working to ensure that soccer fans from around the world are properly vetted and able to come to the U.S. next summer easily. World Cup matches will take place in 11 U.S. cities. And Toyota is investing over $900 million to boost hybrid vehicle production in the U.S. The project will center on hybrid vehicles and component production across 5 states. The move underscores Toyota's bet that hybrids will dominate U.S. sales as consumers resist high EV prices following the end of tax credits. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Jason Tyler of Northern Trust on why tech isn't in a bubble just yet.
There have been huge portions of our market that have been squeezed out or forgotten by, this huge tech leadership. In fact, our best guess is that next year we're going to see some nice return in leadership to financial services as, we get deregulation. New leadership can emerge or at least challenge some of these tech leaders. And that, to me, is a very healthy stock market.
That was Lisa Shalett, the CIO of Morgan Stanley Wealth Management, weighing in on this stock market. This stock market this morning pulling back by 0.5% on the S&P, down by 0.6% on the Nasdaq. A big week still to come. Your trading diary is shaping up as follows. This morning at 10 a.m. Eastern Time, durable goods. At 11 a.m. Eastern Time, President Trump hosting the Saudi Crown Prince at the White House on Wednesday. Fed meeting minutes just around the corner, plus results from Target and the big one, Nvidia. Thursday, a delayed jobs report, plus earnings from Walmart. Earnings from Walmart getting a little bit more interesting following what we heard from Home Depot earlier this morning.
They traditionally have been a bellwether for consumer activity and just appetite, and it might be the cleanest read on just how much consumers are willing to absorb higher prices, how much they have to pass along higher prices, and how much affordability still is at the front and center for so many people out there, as it does seem to be at least part of the dialogue this morning.
Another soft session this morning. We're down by 0.5% so far. Resilience of the AI narrative in question as valuation concerns grip Wall Street. Jason Tyler, the wealth management president at Northern Trust, writing, while there has been a lot of talk about bubbles, we do not think the technology sector is there yet. Jason joins us now for more. Jason, welcome. Thanks for making some time for us this morning. Let's just set the table for this conversation. What is a bubble? How would you define one?
Well, first of all, it's good to at least hear you, Jonathan, and so thanks for having me on. Bubbles are fundamentally when asset prices get way above their fundamental value, and it's ironic you were talking about the possible bubble here in this sector. We just literally last night had our leadership team together, and we're talking about this very dynamic, and we tend to be very fundamentally driven, and so we're always looking for ways to identify what's the intrinsic value of an asset as opposed to looking at just what the market might be looking at and anticipating in terms of momentum.
And Jason, what are you seeing?
Well, I think 6-12 months ago, the fundamentals looked better. And so now we're more on bubble watch than bubble call. That's the way we talked about it just last week. Every week we put out 5 themes to our clients, to investors, and ironically, one of those 5 themes just this past week was that to be more on bubble watch. We're certainly not calling it yet, but doing a lot more analysis to make sure that the asset prices of some of these securities, some of these stocks aren't getting too far in front of what we think their intrinsic value is. And you've got to go out pretty far in the future to think about the earnings that they're going to be developed and discount those back to today to get comfortable with where the valuations are, but so far we're not seeing a big disconnect between those.
I feel like the word bubble sometimes distracts from what a lot of people are talking about, including you just now, Jason, which is that people are pricing in a lot of gains they're going to take a lot longer to take. And I'm looking at this morning the fact that Cloudflare outages are causing ChatGPT to go down and things of that nature. And Cloudflare is the company that you've never heard of that controls a lot of websites across the internet. I just wonder how much the real world is not keeping pace with the hopes and dreams of artificial intelligence.
Yeah, we separate it in terms of 2 different dynamics. One is what are the implications going to be for us as consumers, for us as just going about our everyday life? And then secondly, what are the value of these underlying companies? And in the first, there's no doubt that these dynamics are going to have huge implications for the way we come to work, for the way we do things. But in the second, we've got to be cautious not to get too far, too optimistic about what these values could actually create in these companies. That said, you look at the infrastructure that has to be developed to support the technology that we're talking about, and it's going to be huge investments over the next several years to make sure the infrastructure is there to support what's happening.
How much, Jason, does this really affect where you think the potential profits are from your own investor portfolios? The idea of, is it utilities? Is it the energy structures? Is it something other than maybe the traditional AI plays that have gotten the most attention?
You know, the thing that comes to mind for me a lot, I grew up trained more in the Buffett school of thought and looking for moats and looking for barriers to entry. And frankly, they're hard to find in this sector. And so scale may be one of them, but that's got to be proven out. And so otherwise, you're trying to look for what are some of the longer term advantages these companies have to be able to drive earnings to justify, obviously, the big multiples that we're looking at today.
Jason, just before you go, what's the big call from you and the team as you sit around the table and start thinking about 2026 and beyond? What are you actually excited about right now?
You know, John, what I'm excited about, we didn't get a chance to dive into it today, but the number of companies that are publicly traded is declining. The number of privately held companies that are investable, that have more than $100 million of revenue, it's increasing dramatically. And so what I'm excited about is our ability to help clients find those companies more in the private markets and find ways to create shareholder value for looking at things that might not be on our screens every day, but our team is doing research looking for those types of companies.
Jason, because of the high-profile blow-ups, at least over the last few months, there haven't been many, but they've been high-profile. Has it tempered some enthusiasm to go into those markets of the investors that you cover?
Yeah, I have to acknowledge that's a great thing to bring up, John, and I think the first derivative on it, or even the second derivative, is it's harder to raise money in those spaces right now. And so it's giving you an indication that you've got to be more cautious. And we're always back to looking for fundamental value, not looking to just pile money and steer investors in one direction all the time. This is about giving investors access to a broader array of investment opportunities and giving them a chance to diversify and make sure they're not missing on where some shareholder value is being created.
Jason, this was great. It's good to see you. Hopefully in person next time. Thank you, sir. Jason Tyler there of Northern Trust on the AI situation and whether it's a bubble or not.
Yeah, the idea of what is a bubble is a good way to begin the conversation since everyone seems to define it a little bit differently. It does seem like maybe the word bubble has gotten us away from actually looking at what are the appropriate valuations for some of these companies and how far do we need to see visibility, because certainly there is really profound change and positive efficiencies that can come from some of this technology. It just is harder to extrapolate out in a clean line. And I think that that's really what you're hearing from a lot of investors.
A lot is built on Nvidia. A lot is built on Alphabet, on Microsoft, and there's real money there, real profit, real revenue growth. We can see that, and we'll see that in the numbers when they deliver them tomorrow. It's about whether this whole story is built on other parts of the ecosystem, the weaker parts, the more leveraged balance sheets, the promises that aren't backed up by revenue right now. They're the hopes and dreams. Is that where things are out of sync at the moment?
Which is the reason why people are looking at things like OpenAI and CoreWeave and some of the others, Applied Digital, that backs up CoreWeave. Just to take a step back, it does seem like things are accelerating in a world that relies on the physical infrastructure. And that's the reason why I thought Cloudflare was so interesting. It's the company you haven't heard of that gets a lot of websites to the internet. And it raises this issue of where are the fragilities right now in the ecosystem that will get exposed and be roadblocks for this chain into progression that could potentially delay things and potentially delay the promise of some of the profits.
We all just wanted an easy, smooth glide path into year end, a nice little Mount Up, a Santa rally, call it a year and walk away. And this market's just not letting us right now, is it?
Some people are really excited. You know, the Bears, the Bulls, people who are trying to jog back. Yeah, they had 5 minutes to come out, and now they're being scared back.
Coming up on the programme, Julian Emmanuel of Evercore, Alicia Levine of BNY, Libby Cantrell of PIMCO, Francis Donald of RBC. They'll join us tomorrow morning from New York City this morning. Good morning to you all. Thank you for choosing Bloomberg TV. Have a wonderful day, and we'll see you tomorrow morning.